All right, so today is a very special day for the first day of our revision. And we are not coming to do anything here. We are just coming to revise. We are just coming to revise. So most especially, we'll be revising our mock exam questions, our practice questions. We'll be revising them. I took the pain to answer them the way I understand. I took the pain to answer them the way I understand. Then I've sent you guys the work I have done, and I'm sure by now everybody has reviewed the marking scheme. So today we are coming to use the marking scheme, what I have done, and go through the questions and see if they're in place. If they are not in place, we try to do the necessary amendment, then we move forward. The questions are likely examinable questions. So I'll entreat you to pay attention to the questions. I'm not saying they are the questions that will come in the exam, but they are likely examinable questions. So I will entreat each and every one of you to pay attention to the questions. I've sent some questions on the page. I think I have about 16 questions there. The first 5 are the mock questions. Then I've added some additional 11 questions to it that we'll be discussing for the 2 days. So my hope is we'll finish early so that we'll do general revision of all the principles, the ones that we'll be able to do before for the limited time that we have. My hope is we will answer these questions, we go through them as soon as possible so that we will do what? We will do general revision of the principles. I've been saying it. Every task exam you want to write, every task exam you are going to write, without the principles, you cannot pass the exam because you need the principles to answer the questions. The question can be a written question or a computation question. You need the principles to answer them. Without the principles, you cannot. And I'm very much convinced that by now we are used to at least 80% of the principles. The one we need to pass the exam, we are used to them. I'm not coming to solve the question, but as I said earlier, I have the marking scheme already for question 1 to question 5. We all have it. So we'll go through it and see if that is the right thing. If that's not the right thing, we do the amendment. I hope that is in place. Anybody with different view? Because I cannot be writing now because the questions are already there. So I cannot be writing now. The marking scheme is there. So that's why we use and compare with the details and the requirements of the questions. If they're in place, then we are good to go. If they're not in place, then we do the necessary amendment. Do you agree with what are you okay with what I'm saying?
I don't have any problem with that.
Okay. Because writing now, it will delay, to waste time. So far as we have the marking scheme, let's just use it and we move forward. Because I want us to finish early so that we will do general revision of the principles. So, let me find out. Is somebody having any difficulties for on the question 1 to question 5? Maybe you were going through the marking scheme and some aspects of the marking scheme as compared to the question, you are not okay with it. If somebody have any difficulty, the person can bring it up. If no difficulties, I will assume that there are no problems. So we move to question 6. We start from question 6. Silence means concern. That means we don't have any problem. So what's the general agreement? Senior Adam, today is just revision, so it's not anything new we are coming to learn. So revising. Senior Adam, Senior Christian, Sister Stephanie, Sister Sase, Sister Patience. Any suggestion, any submission concerning what I'm saying?
Hello, sir.
Yes, I can hear you.
Okay, so I think we can just discuss them, the key areas, we try to analyze it, then move on.
Okay.
Then rewriting. Yeah.
Okay, all right.
I have a problem with starting from the question 6 because I couldn't go through the question 1 to 5 comparing with the marking scheme.
What were you doing?
Yeah.
What were you doing?
Oh, you know now.
Okay, so let's start. So, Auntie Agnes, kindly read for us question 1. So, reading the question to waste time. So, what I'm suggesting is we start from the requirement, the first requirement, then we move forward. So, the first requirement for question 1, you have to compute the withholding taxes for 2021 year of assessment for 1 mark. So, in the question, we were told that Odogwu Ghana Limited is a wholly owned subsidiary of Odogwu Nigeria Limited. So we have the income statement for the year 31st December 2021. So we have operating profits 100,000 Ghana cedis, interest charged 600,000. We have foreign exchange 20,000, installment tax paid 50,000, dividend paid 80,000. So you have 2019 and 2020 accumulated assess loss of 813,902 Ghana cedi 45 pesos. Good. There was no chargeable income for the year. Now, we are asked to compute the withholding tax. So in the question, the 2 items that will attract withholding tax is the interest charged and the dividend payment. We know, are they final withholding tax or they are withholding taxes on account? Today we have to talk, so we are coming to discuss. The withholding taxes or the interest and the dividend payments, are they final withholding taxes or they are on account? This one is a revision class, so I cannot be talking alone. Questions will be coming, then you have to be ready to answer them.
I think they should be on account.
Why do you think so?
Because the interest charge, or okay, let me start with the dividend payment. The dividend payment, it's a payment from the subsidiary to the parent, and the parent will be paying other taxes in relation to their business. So that tax that is withheld will be subtracted from the other taxes that will be paid by the parent company. So that is why I think the other one is on account.
So the 2 are on account.
That's what I'm saying.
Okay, who else? Mind you, this is why you'll be writing the exam. The exam is next 2 weeks. So this one, you have to make sure that your answers are according to the principle, that your answers are correct. You cannot be guessing at this stage. This is the revision class. At this stage, you cannot be guessing. No. Who else is coming? I want to see if I can get a note on that. Auntie Agnes.
Yes, sir.
Dividends as withholding tax. Is it final or is on account?
On account.
Dividend is on account.
Yeah.
What about the interest?
That one is on account.
Are you sure?
Yeah.
Okay. I hope that screen showing.
Yes.
Is the screen showing on withholding taxes from investment income?
It is showing.
What is there? The withholding tax rate for payment to resident on account. So these are the ones on account. Interest payment, interest is on account. So that one is right. But dividend is final. Interest payment, 8% to resident person who is not an individual. So interest payment to a company, partnership, and trust, it is 8% on account. That's good. But dividend is final. Dividend is final. So you have to take note. Okay. Can we proceed? Can we proceed? So you see that dividend will take 8%. The interest will take what? Also 8%. So the total withholding taxes will be 54,000. 54,400. Is that okay? Good. Then the next requirement, you have to compute the tax liability for 2021 year of assessment. You have to compute the tax liability for 2021 year of assessment. How will you go about it? We know how you start with the computation of tax liability. You start with your chargeable income for the year. So you have our chargeable income. What's the chargeable income in the question? We don't have any chargeable income, it's 0. Now, I said you should add back the following. So you should add business loss. Why are we adding the business loss? All of you were silent, so that means you understood what I did. Why are we adding back the business loss?
The principal said that the loss will be carried over for 5 years before the loss will be carried over for 5 years. So we have to add it back before we calculate our chargeable income or corporate tax liability. Sorry.
You have to add it back before we do it.
Saying that then, the principal said that in calculating the taxable tax liability for a company, you have to carry forward any loss that the company has made in the previous year.
You can deduct the loss for a period of 5 years. Is that not it?
Yes, period of 5 years. Yeah, that is what I'm saying.
But in this case, if the loss is a deductible expenditure, why are we adding it back? That's my question. The loss can be deducted for for a period of 5 years. But in this question, the company was in operation and the losses were for 2019 and 2020. That means they are still deductible because we are in 2021. The question relates to 2021, but the losses relate to 2019 and 2020. And the loss amount is not the 100,000. The loss amount is 800 and what? How we can see the loss amount? 813,902. That's the total loss. So per the question, what they did, the examiner gave you, they think they have a profit of 100,000 Ghana cedis. So they can only deduct 100,000 Ghana cedis. But that is not the case. There are certain items they have deducted, which are supposed not to be deducted. So why you have to add that loss back. So why you now get your adjusted profit, now you now have to deduct the total loss. Because the loss deducted 100,000 Ghana cedis, that is not the total loss, no. Because they only deduct that based on the calculations they have done. Based on the calculations they have done. So you have to add it back. Then the dividend too, you have to add a dividend back. Dividend is final withholding tax, it's on account. You have to add it back. Then installment tax payment, 50,000 Ghana cedis. Is it allowed? Is it an allowable deduction? If you pay tax on installment basis, is it an allowable deduction? Let's move fast. Taxes paid. Taxes paid is not an allowable deduction. When you pay tax during the year of assessment, the principle is that you can only get a tax credit up to the tune of the taxes that you have paid on installment basis. So you cannot deduct it from your income while you are determining your chargeable income. No, you only get a tax credit for the taxes that you have already paid during the year. So you have to add that one to back 50,000. Now, the interest paid, the interest charge in the question is 600,000 Ghana cedis. So what do we do to the interest? We must subject the interest to the team capitalization rule, because this one, the loan that on which the interest is paid, the loan is from the parent to the subsidiary. So they are persons in a control relationship. They are persons in a control relationship from a parent to a subsidiary. So we must subject the interest paid from the Odogu Ghana Limited to Odogu Nigeria Limited to the team capitalization rule. You have to do that. So I did that calculation down there for you very neatly. Where is it? Aha. So I hope you can see computation of allowable and disallowable interest and foreign exchange loss. So you must subject the interest and the foreign exchange law to the team capitalization rule. The ratio is that the interest paid should not exceed the debt to equity ratios of 3:1. So you have to do that. So the equity given in the question is how much? So what the equity given in the question? Which additional information? This question, I presume you have read through already. So you should be giving me these figures fast so that we move forward.
$1,500,000.
Which additional information is that one?
The last but one.
The last but okay, equity and debt values to that 1.5 million Ghana cedis and 1,025,000,000 naira respectively at the beginning of the year. And at the end, there was no debt. There was no debt at the end of the year. But at the big end of the year, they have an equity of 1.6 million Ghana cedis. Now, why are we not using the equity at end, but we are using the equity at start? These are the assumptions you have to understand before you'll be able to solve the question. Why are okay, let me ask you, which of the equity should we use? Do we use the beginning equity or we should use the ending equity? Who is answering? I'm waiting. Hey, nobody will talk. They will be here till tomorrow. We will not even do up to question 2 before we close today. Auntie Agnes.
Yes, sir.
Which of the equity should we use?
For me, I think the first and the one at the beginning.
Why should we use the one at the beginning? You have to understand what you are doing. You have to understand what you are doing.
Yeah.
At this stage, this is a professional stage. You don't need to memorize the solution. No, if you memorize the solution, what if you forgot? What will you do? You cannot memorize the solution at this stage. You have to understand what you are doing. Who is helping us? But Agnes, have you understood what I did?
Yes.
You understood. So you didn't ask yourself, why is it that I use the beginning equity? Because at the end of the year, there was no loan, there was no debt at the end of the year because At the end of 2021, there was no loan. The debt was 0.00 naira. Can you see that?
Yes.
There was no debt at the end of the year. So you can only use the beginning equity. When you use the beginning, the ending equity, which is 1,600,000, it will not correspond with the beginning what debt. No. So you have to use the beginning equity, which is 1.5 million Ghana cedis, as against the beginning debt. Now, the debt is in naira because the loan was given to Odogu Ghana Limited in naira, in the foreign currency. So what do you have to do? You have to change, you have to convert the naira to Ghana cedis. Now, when we give you the exchange rate, so the last additional information, the exchange rate for the beginning of 2021 is 1 Ghana cedis is to 50 naira. And at the end of the year was 1 Ghana cedi to 59.20 naira. So you have to use the beginning exchange rate to convert the naira to Ghana cedis. So that would be 1,025,000,000 divided by 50. Should we divide or we should multiply? Should we divide or we should multiply?
Divide.
All right. So if you divide, you get 20. When you divide, you get 20 million. You get 20 million. You get 20,500,000. All right. Now the debt,
Please, I want to ask, when exactly do we divide and when do we?
Come again, anti-success. I didn't hear you well.
Please, when do we divide and when do we multiply?
All right. So in that case, why you are confused, you use, how do you call it? That mathematical approach, how do you call it?
If less, more divide.
If what?
If less, more divide.
Okay. So anti-success, this is what you do. The exchange rate given to us, we are giving 1 Ghana cedis. Is that 1 cedis? We are giving 1 cedis. It's equal to what? It's equal to what, the naira? It's equal to 50 naira. Good. It's equal to 50 naira. Do it on your paper there. It's equal to 50 naira. So 1,025,000,000 naira will be equal to what? So it will tell you that you have to divide. Anti-success, are you okay?
Yes, sir.
I can't hear you.
Yes, please.
All right. So
Thank you very
that you
much.
have to divide. Now the debt limit, the equity should be what? 3 times. Because the ratio is 3:1. So you multiply the 1.5 million by 3. That will give you 4,500,000. Now, what is the total interest paid? The interest paid given to us in the question is 600,000 Ghana cedis. So we subject that figure to the debt to equity ratio. So the allowable portion will be 4.5 million over 20.5 million multiplied by 600,000. So you can only deduct the interest up to what? 100 and what? 31,707 Ghana cedis, 31 pesos. So the disallowable portion, you have to add it back. The disallowable portion, you have to add it back. Then the foreign exchange loss too, you subject the foreign exchange loss to the tin capitalization rule. So the same approach, the foreign exchange loss given in the question is 20,000 Ghana cedis. So the disallowable portion will be, the allowable portion is just 4,390 Ghana cedis, 24 pesos. So the disallowable portion, you have to add it back to what? To the chargeable income and tax. You have to add it back to chargeable income and tax. Are we together? So you add, who is talking?
Please, I was only responding.
Okay, all right. So the disallowable portion of the interest, you add it back, and the disallowable portion of the foreign exchange loss, you add it back. Now, in the question, there is one thing you have to do. Again. Auntie Agnes, read additional information 1 and additional up to, I think, the 3rd one for me. Let me see.
Okay. Odogu Ghana secured a loan of 1 billion naira from Odogu Nigeria Limited in January 2019. The interest charged for the year 2019 and 2020 are 750,000 and 650,000 respectively. The interest and foreign exchange loss presented on the profit or loss extract is in relation to the loan procured from the parent company. Payments to the parent company are only made at the end of each year. As at 31st December 2020, only interest of 900,000 Ghana cedis has been paid to the parent company because of Odogu Ghana Limited's financial challenge. No other payment in respect of the loan has been paid aside the 900,000 Ghana cedis.
Okay.
To enhance smooth operation. Should I continue?
Yes, continue.
Okay. To enhance smooth operations, the management of Odogu Nigeria had a meeting early December 2021 to relieve Odogu Ghana from payment of the loan and the interest. They concluded that Odogu should not make any payment to the parent company at the end of the 2021 year.
Okay, all right. Thank you very much. Now, from the question, let me tell you one thing. Every paragraph or everything in a task question, everything you see in a task question is very, very important. So some of the things are not just for reading's sake. No, everything you read in a task question is very, very important. In this question, we were told that Odogu Ghana Limited secured a loan, 1 billion naira from the parent company in Nigeria. So they secured a loan in January 2019. The interest for 2019 is 750,000 Ghana cedis. And 2020, the interest to is 650,000 Ghana cedis. Then the question continued to say that the interest and foreign exchange law presented on the profit or loss extract is in relation to the loan procured from the parent company. Payments to the parent company are only made at the end of the year. Now, as at December 31st, December 2020, they were able to pay only 900,000 Ghana cedis as the interest. The interest for 2019, 2020, and even the 2 years from 2019 and 2020, the interest of 750,000 Ghana cedis and 650,000 Ghana cedis, they were able to pay only 900,000 Ghana cedis because they were having a financial challenges. So they've not made any payment on the loan. They've not paid any interest on the loan, apart from the 900,000 Ghana cedis. So in December 2021, the parent company has decided to relieve Odogu Ghana Limited of the loan. Now, this relief, there's something we call capital gain. There will be something we call capital gain on the relief of the loan. When the parent company, you give a loan to the subsidiary, your subsidiary, and you realize that the subsidiary is not able to pay the interest on the loan because the subsidiary is having a financial difficulties, that relief, you must determine a gain, a capital gain or a capital loss on it. If it is a gain, you have to add that gain to your chargeable income and tax. And likewise, if it's a loss, you are allowed to deduct that loss. You are allowed to deduct that loss. Now, in the case of Odogu Ghana Limited, I've done some nice computation here for you. I've done some nice computation here. So computation of capital gain on realization of a liability. So computation of capital gain. Consideration offered is 0 because this one is relief from a loan. So it's not like they are paying anything or they are receiving anything like in form of what? Realization or assets. So consideration will be 0. Now let's calculate the outstanding debt on the loan. Outstanding debt on the loan. Now, what the loan amount? We are told that the loan amount is 1 billion Ghana cedis. 1 billion naira. So you have to convert the 1 billion naira to Ghana cedis. So when you do that, That will be the 1 billion divided by the exchange rate at the beginning of the year. So that will be 50. That will be 50 because the loan was secured in 2019. The loan was not secured at the end of 2021. So you cannot use the ending rate, no. So you have to use the beginning rate. So that will be 1 billion naira divided by 50 Ghana cedis. That will give you 20 million Ghana cedis. Now you have to find the total interest payable and the amount paid. Are you guys following me?
Yes, please.
All right. Now, so what the interest to be paid on the loan? So 2019, they are supposed to pay 750,000 Ghana cedis. 2016, they are supposed to pay, 2020, they are supposed to pay 650,000 Ghana cedis. Now, in 2021, were we giving the interest to be paid? Were we giving the interest to be paid in 2021?
Yes.
Or the interest paid in 2021?
Yes, 600,000.
600,000 Ghana cedis. Yes. Now, out of this amount, how much was paid? 900,000 was paid. So the difference would be 1,100,000 Ghana cedis. You add this one to the value of the loan. That'll be 21,100,000 Ghana cedis. So this again, because the parent company has relieved them from the payment of the loan and the interest. If you look at the third additional information, it said to enhance smooth operation, the management of Odogu Nigeria Limited had a meeting early December 2021 to relieve Odogu Ghana from payment of the loan and the interest. So they will not pay the principal loan, which is 20 million Ghana cedis, and the interest to the remaining interest of 1,100,000 Ghana cedis they will not pay. So the two combined together will give you the total capital gain, which must be added to their chargeable income. It must be added to the chargeable income. Good. Let's move forward. So you add the capital gain, which is 21,100,000 Ghana cedis. Then you now have your adjusted profit. In this case, you can see that we have the adjusted profit is higher, so you can deduct our unrelieved losses. The total unrelieved losses of 813,000 Ghana cedis, 902 cedis. So you have to deduct your unrelieved losses. Then you now have your chargeable income. Then what will be the tax rate? What's the tax rate that they will pay? I'm using 25%. Is that correct?
Yes.
All right. So they will not pay tax at 25%. Then you will now have to give them a tax credit of the installment tax paid, which is 50,000 Ghana cedis. Then you now have your net tax liabilities of Odogu Ghana Limited. Other question? So the third requirement is we have to compute the total tax. So you just add the total withholding taxes payable plus the net corporate tax payable. The two, just add the two together. That'll give you the total tax payable. Other question?
Yes, I'm not too clear about the treatment of the dividend payments in estimating the chargeable income and the tax payable.
The treatment of the dividend.
Dividend payment.
We just add it back, that's all.
You gave some explanation for the adding back.
Oh, I said dividend is final. Dividend take 8% final withholding tax. But in this case, they deducted it. They deducted it. In the question, they deducted it before getting their chargeable income. So you just add it back.
So what happened to the amount that they have withheld?
It will be that one you pay it by 15th day of the following month. You pay it to the Commissioner General. That is not the tax.
So it will not affect the profit.
No, the tax will not affect the profit. No, that is final withholding tax. So you will have the tax on the dividend to be paid or dividend paid to the shareholders. So the taxes withheld in this case, how much is the taxes withheld on dividend? It's 6,400. So by the 15th day of the following month that the tax was withheld, you pay this amount to what? To the Ghana Revenue Authority. That ends it there. It will not have any effect on profit, no. Are you okay?
Okay, let's go.
So what about the interest? Why are we disallowing the portion of the interest? What about the interest? Because the interest is on account. Is that not it? So the interest, no matter what, you have to add the interest back. Then the interest paid, you have to what? It's a deductible expenditure. Interest is not a deductible expenditure.
Yes.
Yes. So that's the reason why you have to subject it to the thin capitalization rule. Because interest is a deductible expenditure. The only thing is, while you are paying the interest on the loan, you withheld a tax of 8% on it. You withheld the tax of 8% on the amount of interest that you are going to pay. And that tax you have to pay by the 15th day of the following month. You have to pay that tax to the Commissioner General. I beg you, give me 1 minute. I'm coming. Okay, Sebas, I'm back. So I
Let's
was saying,
continue.
I should continue.
Yes.
So interest payment is tax deductible. It's tax deductible. The only thing is, if the interest is paid, or the interest is going to be paid on persons in a control relationship, you subject the interest to the thin capitalization rule. Subject the interest to the thin capitalization rule. Okay. So let's go to the B part. I still on question 1. Hey, let's go to the B part. Auntie Agnes, read for us. The B.
B. Ebusian Dwarf Limited. Ebusian Dwarf Limited, located in a free zone, commenced. Please, can you push it up a bit?
When I'm pushing it up, it's misbehaving. It's going to the next page. You can't see it.
Oh, I'll try and then.
Okay. I hope it's okay now.
Yes.
Okay. If you are reading, we cannot hear you, please.
I'm adjusting my screen.
Okay.
Okay. B. Ebusian Dwarf Limited, located in a free zone, commenced operation in 2009. A new tax accountant was employed in January 2019, but lacked the expertise to diligently execute his duties as tax expert. The management have expressed their persistent worry about the new tax accountant to accurately calculate the business tax obligations to agree with what is assessed by the Ghana Revenue Authority each year. The management in March 2022 decided for the first time to import direct material from the UK for production of finished goods for sale to the domestic market. Also, they have planned to pay 55% of their post-tax profits to shareholders. transfer 15% to stated capital, and retain the remaining 30% in the business. The management has contacted you, a tax intern of Assurance Tax Consult, for advice about their new line of action. Required. Write a report to management about the tax implication of their new line of action.
Okay. What are they even saying? What is the question saying? Somebody should break the question down for us. I don't know what the question is even saying. Okay,
They
so
are saying,
they are what?
they said they are located in a free zone.
Okay, free zone. Okay, all right.
Yes.
Mhm.
And their new tax accountant is not able to calculate their tax liabilities to agree with what the GRA has been bringing.
Okay,
And they have also decided to import some materials, and they've decided how to distribute the profits they will get.
okay.
Yes.
So what ratio are they going to distribute their profit? So they have planned to pay, okay, 55% of their post-tax profit to the shareholders. So it means that they are going to pay 55% of their post-tax profit as dividend to the shareholders. Then they will do what? They will transfer 15% to stated capital, okay. And the remaining 30%, they will remain 30% in the business, all right. So the management has contacted you as a tax intern for advice about their new line of action, all right. So let's start. By this one, we are going to start in general. We are going to use this question to learn a lot of things. We are revising. A company located in a free zone. What's the tax implication of a free zone company? We are using the question to learn so many things. We are revising, so you must be ready for the exam. You don't know what to come. If we answer the question based on the requirements of the question, you have to write a report to management about tax implication of their new line of action. So their new line of action is they want to pay 55% of their post-tax profit to shareholders as dividends. Then they will remain 15%. They will transfer 50% to stated capital. Then they will plow back 30%. So the three proposals are their new line of action. So the question, you have to write a report on the three proposals. All right. But I'm asking, the company is located in a free zone area, even though we were not asked to write anything on the free zone. But in answering this question, definitely we must say something small about free zone. You must say something small about free zone. So what are the tax implications on the free zone company?
Yeah, hello.
Yeah, I can hear you.
So what I know is that for the free zone companies, they are tax-free companies for the first 10 years of operation.
Okay.
Yes. And there is also export and import duties were excused, right? Like they don't pay those ones too, for the same period of 10 years.
Okay.
Yeah. So that is the little I know about free zones.
So what about after the 10 years?
After the 10 years, they will pay tax at 15%.
50% on what?
15%.
On what?
On export.
On export. After the 10 years, they will pay tax at the rate of 50% on income from export. The free zone companies, they are authorized by the law to what? To sell up to only 30% of their produce in the domestic market. So when they do that, after the 10 years, any income they get from selling to the domestic market, they pay tax at the rate of 25%. But when they export, they pay tax at the rate of 15%. Take note of that. All right. And when they settle, I have a write-up here nicely for you. You have to read. Okay, then let's read it. So we are learning together. So Auntie Agnes, read for us. Read only the free zone aspect. I said this question is 10 marks. 10 marks. So in answering this question, you cannot just say that when they pay dividend, they will pay final withholding tax of 8% on dividend. Then when they transfer to the stated capital, it will be deemed as dividends in taxation. So they will pay 8% tax on 8% withholding tax, then they will pay 0.5 stamp duty. Then when they return in the business, that one, they don't pay the tax. You cannot just write that and get your 10 marks. No. First, you must start from the free zone because the company is located in the free zone area. The company is a free zone. So you must start from the free zone. So the write-up is there for you. You read it. You read it. Or what do you suggest? You go through it.
Yes.
We are revising, so there's no problem going through.
There's no problem going through it.
Mm-hmm.
Okay. So I've written the report for you. I think selling to domestic market. So for 10 years, a free zone developers or enterprises exempted from payment of income tax profit. Now, the chargeable income of a free zone enterprise after 10 years tax holiday on export of goods is subject to a tax at the rate of 15%. Then the chargeable income from selling to the domestic market after the 10 years holiday is subject to tax at the rate of 25%. I'm not reading the thing directly, so you have to bear with me. There are 100% exemption from payment of direct and indirect taxes. They don't pay that one, we know. Now, when they sell to a domestic market, they will pay the following taxes. When they decide to sell to domestic market, they will pay the following taxes. They will pay duties on the product or produce on duty, or as duty was not paid at the time of importation. So when they sell to domestic market, they will pay the duties. Then they will pay all VAT on the goods. They will pay National Health Insurance levy. They will pay Get Fund levy. They will pay COVID-19 levy. And they are only limited to sell up to what 30% of the finished goods to the domestic market. All right. Let's move forward. And when they sold to the domestic market, we said that earlier, they will pay tax at the rate of 25% on the chargeable income derived from selling to the domestic market. Now, payment of dividend. We know that one already. We know that dividends attract 8% final withholding tax. But let me go up. What is the tax rule on payment of dividend by a free zone enterprise? Do they pay the 8% tax? A free zone enterprise, when they pay dividend, are they subject to pay the 8% final withholding tax?
The question again, please.
Free zone enterprise, are they subject to pay? Did they pay the withholding tax, the 8% withholding tax?
Yes, they will pay it.
You say what? I didn't hear you.
They will pay it.
They will pay it.
Yes.
Okay. Who else? Free zone enterprise, withholding tax. Did they pay withholding tax? Are they exempted from withholding tax on dividends? The question is yes. They don't pay. They don't pay the withholding tax. Say fast, take note. Free zone.
The withholding tax, is it for the company or it's for the?
It's on the dividend.
Income, is the dividend that the shareholders will receive, is that not it?
Yes.
So even the shareholders too, they will not pay anything on what they are receiving.
No, they don't pay. They don't pay that tax. You know, the withholding tax on dividend is taken from the dividend paid to the shareholders.
Yes, I know.
That will create the economic double taxation. I hope you know that.
Yes.
That creates economic, because you are taxing the same income from the same source. You are taxing the income at the corporate level, then you are still taxing it at the dividend level as a dividend to the shareholders. So shareholders for a free zone enterprise, they are exempted from the 8% withholding tax. So you kindly take note of that. So that one, they don't pay it. So the 55% proposal of the new as a new line of action by the management of a mutual. I can hear you, Senior. So the shareholders of Ebusuanda Limited shall not be subject to pay the withholding tax. So the 55% of the post-tax profit paid to them as a dividend, they will not pay the withholding tax. All right, take note of that. Then the transfer. You see, this question is very, very technical. Because the company is a free zone. When you are answering it, you must relate it to a free zone. If it is a normal business who is not a free zone enterprise, who is not in a free zone, or who is not registered under the Free Zone Act, they will pay the dividend. They will not be exempted from it for it. But because the company is a free zone, the shareholders will be exempted from paying the 8% withholding tax. Now, the transfer of the 15% to the stated capital, that one too, they will be exempted from the withholding tax. But they will only pay the stamp duty of 0.5%. So in answering this question, you must know that the company is a free zone, is located in a free zone. So the shareholders are exempted from the 8% withholding tax. And when they transfer to the stated capital, when they transfer to their equity, that one too, they will be exempted from the withholding tax. They will not pay the 8% withholding tax. They will only pay the stamp duty of 0.5%. So if you don't know this, how will you answer this question? So kindly take note. Now, the retained profit, the 30% they want to retain, that one, retained profit is not subject to tax, whether you are located in a free zone or you are not a free zone enterprise. Retain earnings. When you retain your profits, you don't pay tax on it. That one is not subject to tax. All right. Any question? Let me move on to question 2. Auntie Agnes, read the question 2 for us. If you are not clear with anything, kindly ask me. Kindly talk. Because you will not have the chance again. You won't have the chance again. So if you are not clear with anything, kindly ask. Zephas, I hope you are okay.
Yes, please.
All right. Auntie Agnes, read the question 2 for us.
Okay, please. Question 2. The management of Pinto Limited is planning to restructure the business for the coming year. The business reorganization will start on 1st January 2025, but hoping to end in March 2025. Please, is it better?
It depends on who the person is talking to. Is the person talking to you or the tutor?
Maybe the person is talking to me.
Okay. Okay, question 2. The management of Pinto Limited is planning to restructure the business for the coming year. The business reorganization will start on 1st January 2025, but hoping to end in March 2025. The management of Pinto Limited
Auntie Agnes, if you are ready, we cannot hear you, please.
Hello.
Yes, we can hear you.
Okay. The management of Pinto Limited's plan is to join Limited for the coming year. Management has approached you, an ICAG final level student, on the tax implication of this arrangement. the tax implication of this arrangement in management and ways they can plan to minimize the tax effect of the proposed arrangement.
Okay. So let's analyze the question. Let's discuss the question. What is the question talking about? What is the principle that the examiner is testing here? The business, the Pinto Limited, they are planning to restructure their business for the coming year. Okay. So the restructuring will start on January 1, 2025. They are hoping to end in March 2025. So the management of the Pinto Limited, they plan to join force with what? Assurance Limited for the coming year. So they are planning to what? To join force. So that is what? What are they trying to do? So they have
Merge.
approached, they are trying to do what? They are trying to merge. Is that not it?
Yeah.
All right. So they've approached you as a final level student of ICAG. So you have to advise them or you have to discuss the tax implication of this arrangement. So what are the tax implication of this arrangement? What is the tax implication on merger, amalgamation, or reorganization? This one we have been discussing it every day.
And please, can I try?
At this time, you are not supposed to try. You are supposed to be sure of yourself.
Oh, okay.
Yes.
So,
Even if it is not right, you are supposed to be sure of yourself.
okay.
Yeah, but this is not time for trying, no.
Okay.
So
the principle we learned, they said if the change occurs within 3 years of operation, then we assume that all assets and liabilities have been realized. And then we calculate the gain or loss from the change. And then if it is more than 50%, the change is more than 50%, any gain you obtain from the change is exempt from tax. But if it is less, it is not exempt from tax. Yes, that's what I think.
and you are sure that will give you 5 marks. You have to answer the question as if you are writing examination hall. So this question, while you are answering, you answered on the two sides. They are trying to join force with Assurance Limited. So, like what you rightly said, when the change occurs within 3 years, within 3 years period, when the change occurs, change in ownership. That one is change in ownership. But this one is merger, but they are related. They are the same principle. When the change occurs within 3 years, you are able to change ownership. And the change is more than 50%. It's assumed that what? All assets and liabilities of the company has been realized. Good. Then you have to determine gain or loss on the realization. You have to determine gain or loss on the realization. When you come to merger, so in this question, while you are answering it, both management of Pinto Limited and Assurance Limited, any of the two companies that will hold what? 50% or more of the underlying ownership of the combined business, any gain or loss that is resulting, or any gain that is resulting from that merger will not be subject to tax. But if any of them should hold less than 50%, any gain relating to that person will be subject to tax. Is that okay? So it's a question can ask you, what is the tax measure? What is the measure they have to put in place to minimize their tax liability? A question can ask you that. Like the same question, two companies they want to merge. Like in the case of Pinto Limited and Assurance Limited. So they ask you, you should advise them on the tax planning measures that they have to put in place to minimize their tax liabilities. In that case, what will be your response?
So they have to each make sure that they have at least 50% of the assets of the company.
Thank you very much, brother. Thank you very much. Thank you very much. So in that case, they have to make sure that the change resulted in such a way that both of them, they have 50%. In that case, any gain will be what? Will be exempted from tax. Any gain will be exempted from tax. All right. So I have the requirement there for you. So you take your time and read the answer. It's even there. The question says, even discuss tax implication of this arrangement to management and ways they can plan to minimize the tax effect. Okay, it's even part of the requirement. Even part of the requirement. So you have to state that. You have to state that. So plan to minimize the tax effect. Okay. As indicated above, the company will be exempted from payment of capital gain tax under section 47 of Act 896 if any of the companies hold 50%. All right. Therefore, the two companies can plan to hold 50% each in the underlying ownership in the assets of the reorganized company. All right. That's very good. That's very good. So let's go to the B part. You have to explain the extent to which this statement is true in line with the provisions of the Act. So the statement is that an enterprise eligible for foreign participation requires voluntary foreign contribution, capital contribution by non-citizens. So you should explain the extent to which this statement is true in line with the provisions in the Act 865. All right. We know that there are some enterprises that are solely reserved for Ghanaian citizens. What topic have we done? Have we treated that? I'm sure we've done that too, or?
Yeah, we did it.
Yes. And there are some group of people that are not necessarily required to pay the capital requirement to, even though they are not citizens, they are not required. They can decide to pay, but they can decide to do it on the voluntary basis. There are some group of people that the principle permit them. They can, even though they are not citizens, they can decide to venture into enterprises that are solely reserved for Ghanaians. So that's what the question is the examiner is trying to ask you here. That's what the examiner is trying to ask you here. So who are those group of people? Who are those group of people? So the first one is a foreign spouse of a citizen of Ghana, to the extent that the foreign spouse is or has been married to a citizen of Ghana for a minimum period of 5 years, continuously, or holds an indefinite resident permit prior to the registration of an enterprise. So if you are a foreign, you are a citizen of Ghana, but your wife is a foreigner, and you guys have been married for a period of 5 years, and your wife holds an indefinite resident permit in Ghana before the enterprise was registered, then she is permitted to engage in such enterprise without meeting the capital requirement. The second one is a citizen of Ghana who loses the citizenship by reason of the assumption of the citizenship of another country. This thing we've done them. Then any foreigner that engages in a portfolio investment, an enterprise set up solely for export trading and manufacturing. So kindly take your time and go through them. The C, you have to explain economic double taxation and discuss how it can be eliminated. What is economic double taxation? This one is revision, so I'm not supposed to be talking too much. This one is, we are doing revision, so I'm not supposed to be talking too much. You have to explain economic double taxation. What is economic double taxation?
It's when a tax subject is taxed in the hands of two individual taxpayers within the same period.
Two individual taxpayers.
Yes, within the same period.
So that means the tax is on the same tax object, is that it?
Yes.
Okay, so the best example is the dividend. Is that it?
Yes, please.
Dividend is tax. That means the dividend will be taxed because the profit that was shared will be taxed at the corporate level, and the dividend will also be taxed in the hands of the shareholders. So economic double taxation can be defined as taxation on two different persons in respect of the same income, all right? In respect of the same income. So the most typical cause of economic double taxation is the simultaneous taxation of a company's profit at the level of the company and of the dividends at the level of the shareholders. Now, how can you eliminate economic double taxation? What do you think? How can you eliminate it? How can you eliminate economic double taxation? Based on the principles we've learned so far, the tax principles we've learned, how can you eliminate in Ghana? How can you eliminate economic double taxation? How can you structure your tax in such a way that you will not pay tax on your dividend? You see, this question is not straightforward, but you have, if you meet this question in your exam, what will you write? So far, I can think of two ways that you can eliminate economic double taxation. The ways you can think about, the first one is, or the way you can do it, how will you minimize, or what activity will you engage in that will make you not to pay tax on the dividend? So how can you eliminate economic double taxation in Ghana?
I think by being in the free zone.
Thank you very much, my sister. By being in the free zone enclave, because shareholders, dividend received by shareholders as a free zone enterprise is not subject to the present withholding tax. What other way? There is a principle we've learned. There's one principle we've learned. What other way can you eliminate economic double taxation? There is a principle that states that dividend paid by a resident company to another resident company, whereby the company paying the dividend. No, whereby the company receiving the dividend, yes. Whereby the company receiving the dividend controls at least 25% of the voting power in the company paying the dividend. That dividend is exempted from tax. Can you remember that principle? Are you guys familiar with that principle? Stefas, can you remember that principle?
Yes, please. We've spoken about it.
Yes, we've spoken about it. So that is another way of what? Eliminating economic double taxation. That's another way.
What will it mean? That the shareholders will form another company that will be a parent to the one that is paying the dividend?
Exactly. So what they can do is you can try to merge. You can try to merge or open a branch or have a subsidiary, whereby in the subsidiary you control at least 25% of their voting power. That dividend is what is exempted from withholding tax. So it's a tax planning measure. They can decide to have a branch, have a subsidiary, whereby the parent company will control at least, the word is at least 25%. You can control more than that, but at least 25%. If that company pays dividend to the shareholders of the parent company, that dividend will not be subject to withholding tax. That dividend will be exempted from withholding tax. So that's another way of eliminating economic double taxation.
That will only be in the books of the subsidiary, right?
Yes,
because at the end of the day, the parents will still pay dividend, and that one they will pay the double economic double taxation will take effect there.
Yes, so that will only be in the book of the subsidiary, yes.
Okay.
But that one too, the shareholder, they will enjoy that money. They will not pay the money, the dividend they receive from subsidiary, they will not pay any withholding tax on it. You see, so in Ghana, these are the two cases here. Those are the two cases. All right. Then let's go to D. Auntie Agnes, read question D for us.
D. Opele Manufacturing Limited, located in Kumasi, earned a rental income from Nigeria. The net foreign rental income earned for 2021 year amounted to 5,913,000 naira. In the home front, the business earned a post-tax profit of 121,875 for 2021 year of assessment. Additional information: there is no double taxation treaty between Ghana and Nigeria. Exchange rate is 1 cedi to 65.7 naira. Nigeria withholding tax rate on rent payment is 10%. Ghana has adopted two methods in eliminating double taxation under Section 112 of Act 896 as amended. Required: I. State 6 benefits that Ghana and Nigeria stand to gain from this arrangement. II. Compute tax payable to GRA using the two methods and comments on the appropriate method for the taxpayer and the government.
Okay, thank you very much. This is another very interesting question on international taxation. Under international taxation, we've discussed methods of granting tax relief. So we can have the credit method and the deduction method. We've discussed that. Now, in this question, in the question given to us, what is the question? The question before us, Opele Manufacturing Limited is in Kumasi, and they earned a rental income from Nigeria. So the net foreign rental income earned for 2021 year was 5,913,000 naira. In the home front, the business earned a post-tax profit of 121,875 Ghana cedis for 2021 year of assessment. So Opele Limited, they are in Nigeria, Kumasi. They are a manufacturing company in Kumasi, but they still have some properties in Nigeria on which they earned a rental income. And the net income, pay attention to the question. The net foreign rental income from Nigeria was what? 5,913,000 Ghana cedis. That means the withholding tax of 10% in Nigeria was deducted on the rent income before the net amount of 5.913 million naira was remitted to Opele Manufacturing Company in Ghana. So first requirement, we are told that there is no double taxation agreement between Ghana and Nigeria. This is just the question, but in reality, Ghana and Nigeria, they have a double taxation agreement. So the question is telling you that there is no double taxation treaty between Ghana and Nigeria. That's what the question is saying. But in reality, there is a double taxation agreement between Ghana and Nigeria. We are giving the exchange rate, 1 Ghana cedis is to 65.7 naira. And Ghana has adopted two methods in eliminating double taxation under Act 896. So you have to state 6 benefits Ghana and Nigeria stand to gain from this arrangement. So what are the benefits? So I have them.
It promotes foreign trade.
You promote foreign trade. All right. Whatever comes into your mind, you have to write it. Promote foreign trade, promote foreign investment. It prevents international tax avoidance and tax evasion. Now, you have to compute, the second requirement is you have to compute tax payable to Ghana Revenue Authority using the two methods, using the credit method and the deduction method. Now, under the, let's discuss this thing before we start the question. Let's recap, let's refresh our mind. Let's refresh our mind. The deduction method, how does it work? That's now you're supposed to know.
Under the deduction method, the withholding tax that is paid in a foreign country will be deducted from the total income that is brought or repatriated to the country before tax will be charged on it.
Okay, all right. So the amount paid as a tax, the total amount to be deducted from the global income before the net one, that's the one that the tax will be applied on. What about the credit method? How does the credit method work?
That one, a new tax rate will be calculated in Ghana. Let me just use Ghana to. A new tax rate will be calculated in Ghana and it will be compared to what is charged in the foreign country. Okay. So if the Ghana one is more than the foreign country one, then all the foreign country one will be exempted. But if it is smaller, it will be exempted up to that limit.
Okay, it will be, if it is smaller, if which one is smaller? I want to be clear. I want to be sure of myself.
That one, I myself, I don't know what I'm saying.
The credit method, that's what you said. The tax paid in the foreign country, the rates will be determined. Then the total tax rate to be paid in Ghana to be determined. Then you compare the two rates. If the Ghana rate is higher than the foreign rate, then the total tax paid in the foreign country will be granted as a tax credit. But if the Ghana rate is smaller, you will only be granted a credit up to the twin of the Ghana rate. So, are you okay?
That's what I just said first.
That's what you said first, eh?
Yes.
But why did you change it?
Oh, I just said I wasn't, like me myself, I was confused when I was saying the thing.
All right. But you said smaller, but I don't know which of the rates you are talking about to be smaller, either the Ghana rate or the foreign rate. That's the reason why I want to be sure.
Oh, it's because maybe you didn't hear me well.
Okay, all right. Okay. Now, let's move on. In this question, we have to use the two methods to calculate the tax payable. To calculate the tax payable. Now, what is the first one here? But what I've done, I think when I was converting it, it didn't shift to us. So the first column is for the credit method, and the second one is the deduction method. So you have to calculate the global income of Opele Limited. We know in Ghana, we are using the global system of taxation. So far as you are a tax resident in Ghana, all your incomes from the worldwide, if brought to Ghana, all your income from the worldwide will be taxed. We are using the global system of taxation. So Opele Manufacturing Limited, they are in Kumasi. Let me do these inquiries. Today there is revision, so you do questions anyway, anyhow. A manufacturing company located in Kumasi, what will be their tax rate on their corporate income? Manufacturing company located in Kumasi, what will be the tax rate on their corporate income?
18.75%.
All right, so they enjoy a rebate of what? Of what percent?
75%.
I'm talking about the rebate too. They enjoy a rebate of what percent? Up to what percentage? Up to 25%. So they only pay 75% of the statutory 25%. So that will give you 18.75%. All right. Good. What about if the company is located in other regional capitals?
Rebate of 50%.
Rebate of 50%. So they will pay tax at the rate of 12.5%. Is that what it? But located in Accra and Tema, that one there's no rebate. So they will pay a full tax at the rate of the 25%. So now let's compute the income from Ghana. Income from Ghana. Income from Ghana. We were told that in the home front, the business earned a post-tax profit of 121,875 Ghana cedis. This is post-tax. That means the tax was deducted already. So what should we do? Anti-success, you asked the question today how to convert. I'm sure anti-success is here. In the question, the business earned a post-tax profit. That means tax was deducted, and this is the net. You must get the gross. You must get the gross. So what do? You must get the 100%. So it means that they will pay tax at the rate of 18.75%. They will pay tax at the rate of 18.75%. So that means a tax of 18.75% was charged on their gross income before the net is now 121,875 Ghana cedis. So you must get the gross. You must get the gross. So this one, we are looking for the 100%. So that will be 100 over 81.25 multiplied by the post-tax profits. That's 121,875. Are we okay with that? Is there any alternative way to get that, to get the gross?
Yes.
What's the alternative way to get the gross?
We can equally divide the profit, the net post-tax profit. We divide it by the 18.75, by the difference of 18.75 and 100%, which is 81.25%.
So that will be what? That will be 0.8125. Is that what it?
Yes. So 121,875 divided by 0.8125.
All right. So it will give you the 50,000. All right. Then the rental income from Nigeria. That one too, we are told that is the net. The 5,913,000 Ghana cedis, that is the net amount. A tax of 10% was deducted. A tax of what? 10% was deducted. So that one too, first, this is a foreign currency, so we have to convert it to Ghana cedis. We are giving the exchange rate, 1 Ghana cedis is equal to 65 naira 70 pesos. So the conversion will be 5,913,000 divided by 65.7. Then you now multiply it by what? 100 over 90. We are looking for the gross. I think that's okay. Any problem, any question concerning that? So you add the two, that gives you the global income. So when you are using the credit method, you have to wait, get the rate before you deduct. Now, the deduction method, as Sefa said, the deduction method, the foreign taxes paid will be deducted from your total income before the tax will be charged on the net. So the taxes paid will be 10% on the 100,000 Ghana cedis. So that will give you 10,000 Ghana cedis. So that will come under the deduction method. Then when you do that, the chargeable income under the credit method will remain your 250,000. Then under the deduction method, your chargeable income will now be 240,000 Ghana cedis. Now, the tax paid. So you now have the tax paid. So you calculate the tax, 18.755% on the chargeable income. Now, when you're using the credit under the credit method, you must compare. In Ghana, what will be the tax rate on the rental income? What will be the tax rate? I hope you are following. If you are not clear with anything, kindly ask. So this is the last time. So this one, you will not have the time to ask.
Is that residential or commercial?
Are you asking me?
15%. 15%.
Anti-success.
Please, 15%.
Why 15%?
Please, since it's a commercial business.
Okay, thank you very much. The company is the thing is a company, so it will be it's a company, so it should be that the rate is 15%. Now, when you compare the 15%, so 15% on 100,000, how much will you get? That's the tax that will be paid in Ghana. 15% to 100,000, how much will you get? That give you
You will get 15,000.
that give you 15,000. So it means that the foreign tax paid, which is 10,000, will be granted as what? As a tax credit. As a tax credit. Then the company will now pay the net. Because the tax to be paid in Ghana is higher than the tax that was paid in Nigeria. It's higher than the tax that was paid in Nigeria. So you deduct the 10,000, then you have your net tax payable. So for the deduction method, the tax will still be the 18.75% on the 240,000 Ghana cedis. Now, the two method, which one will favor the taxpayer? Let me find out. Because you don't know the question that will, they even ask you, using the two methods and comment on the appropriate method for the taxpayer and the government. Which one will favor the taxpayer and which one will favor the government? So that the question is very, very brilliant.
Government will go for the credit method and the taxpayer will opt for the deduction method.
Come again.
Government will opt for the credit method, whilst the taxpayer will go for the deduction method.
Are you sure?
Yes, because
The taxpayer go for the deduction method.
With the credit method, the taxpayer is paying more tax, and that is a gain to the government. And so they will.
Are you sure? Are you sure?
Yes, they are paying 46,875 cedis as tax.
That is not the tax. That is not the net tax.
Oh, okay. Oh, okay. All right. So the net tax is 36,000.
Yeah, the net tax payable to GRA. Under the credit method, the foreign tax must be deducted. Must be granted as a credit to the taxpayer.
Oh, okay. All right. Then in that case, the government will rather want the deduction method.
Because they want money for development, so they'll go for the deduction method. But the taxpayer will prefer the credit the credit method. All right. You write that one for 1 month. Very, very important.
Yes. Do you know what worries me in this computation, or especially the tax credit?
I don't know.
We know that rental income is 15% in Ghana, and they are telling us that the Nigerian rental income is 10%. So off head, we know that the Ghana's own will be higher than Nigeria's own.
Exactly.
So why don't we just from beginning deduct the 10%, since definitely their own is more, we just give it to them as tax credit before we charge the taxable income, just like we do for the deduction.
No. That is not an income. That is taxes. That is tax paid. So it will be granted as a tax credit. It is supposed not to be deducted from the chargeable income. No.
Okay.
It's tax paid. It's a foreign tax paid. So it's supposed to be granted as what? As a tax credit. So you only deduct it from your tax payable before you get your net tax to be paid.
Okay.
Deduction method, you are not talking about tax. Deduction method talk about income. Deduction method is not about the taxes that you have paid outside. No. But it's the amount of income that you have lost, the amount of income that you have lost in the foreign country. So it's not talking about deduction method, does not talk about the tax. Credit method talk about the taxes that you have paid in the foreign country. It will be granted to you as a tax credit. So you only deduct it from your tax payable to the Ghana Revenue Authority before you pay the remaining. How that's okay now?
Yes.
All right. Okay. So let's move on. Question 3. Auntie Agnes. Okay, question 3. Outline six expenditures to the government. All right. Government sometimes incur tax expenditure for implementing certain tax policies to assist the taxpayers. So you are to outline 6 of these expenditures to the government. I've taken my time. Okay, I gave you at least 14. You have to outline 6. Let's move on to the B part.
Please, how are these expenditures?
How are these expenditures? How are they expenditures? Is that your question?
Yes.
Okay. Tax holiday. When companies are on tax holiday, do they pay tax?
They don't.
Okay. That amount that the GRA will get from them on that tax holiday, are they not going to lose that amount of money?
So it has become expenditure.
That's become expenditure, yes.
I thought the expenditure is money spent or something.
See the question. The government sometimes incur tax expenditures for implementing certain policies to assist the taxpayers. So you have to outline 6 of them. But do you agree with the carryover losses?
Oh yes, to reduce the tax payer.
Tax credits is also there. Exemption from cost. They lose those money, so it's a form of expenditure to the government. All right. The B part. Auntie Agnes, read the B part for us. Question 3B. Today I want us to discuss up to question 10.
To reach there.
Are you sure? We've not started early, so we will try. I want us to discuss up to question 10. Auntie Agnes, if you're on the call, kindly read the question 3B for us. Auntie Agnes is not there. Auntie Agnes, are you reading?
Yes. Please, can you hear me?
Yes.
Hello.
We can hear you now.
Okay. B. Kenworth Limited needs a
If you are reading, we
for
cannot
its operations.
hear you.
How to have adequate
Auntie Agnes, if you are reading, we cannot hear you, please.
Hello.
Yes, we can hear you now.
Okay. I don't know if it's my network.
Yes, I believe so.
Okay. Kenworth Limited needs a motor vehicle for its operations. However, management has expressed that the business does not have adequate resources to buy the asset outright. Kofi Addo, the procurement manager, heard on radio that a leasing company has installment sales, financial lease, and operating lease packages for its customers, and has already discussed that with management. Management is confused about the package going on. They approached you this morning for education on this matter. Required: I. Discuss the differences among finance lease, operating lease, and installment sales of an asset in accordance with the Income Tax Act 2015 at 896 as amended, and the Income Tax Regulations 2016 LI 2244. II. Advise management on the best option on taxation grounds.
All right, thank you very much. This one, read what I did, the suggested answer I have here. Kindly read it for us. This question I know for 6 marks at least. I'm sure most of you will not want to get it. So, Auntie Agnes, kindly read what I've done here.
Okay. Installment sales of assets. Under installment sales, the purchaser deposits an amount and arranges to settle the balance by making regularly fixed payments over a period of time. There is no interest element in the down payment, that is initial deposit, as it is paid on the date of the transaction. Installments paid after certain periods includes interest portion. The parties involved in the installment sales agreement include the buyer and seller. In line with Regulation 16 of Acts of LI 2244 and Section 30 of Act 896, the Commissioner General shall recognize an installment sale transaction as a sale of the assets. There is always initial deposit under installment sale, of which the amount does not include interest components. Also, the Commissioner General shall, in respect of the seller, treat the cost of the asset as the cost of trading stock disposed of by the seller, and the seller's revenue as income in the year the asset is sold under the installment agreement. Again, the Commissioner General shall, in respect of the seller, recognize only the interest receivable for each year of assessment as income to the seller. See Regulation 16 of LI 2244 and Section 30 of Act 896.
Are we getting the installment sales? Me myself, I'm confused. What are they saying? Installment sale of assets. You buy an asset and you are paying on installmental basis. What is the principle saying? Me myself, I'm confused.
They said the Commissioner General will only recognize the interest that is paid or received, and that is what the tax will be charged on.
Yes, it's only the interest portion. It's only the interest portion because under finance, what I want to use some accounting standard, but let me not go there. Under the installment payment, it means you pay initial deposit and later pay the remaining part of the cost of the asset. And the initial deposit will always be paid on the date of the transaction. You have to deposit some amount of money. Now, the installment payment after certain period will include an interest portion. Because that one, definitely the cost that the seller will sell the asset to you, they will calculate the interest because of time value for money. They will calculate the interest and add it to the cost before you agreed on it as the cost of the asset. So when you make the initial deposit, that one, there's no interest portion of it. But the subsequent payments you are going to make, there will be an interest portion of it. So that is the interest portion that the seller will receive. It is only that portion that the Commissioner General can recognize and the tax will be charged on it. It is only that portion of the interest. It is only the interest portion. Then let's come to the finance list. This thing is plenty here. The finance lease, we know the finance lease, but let's read from, I think I can read from point 2. The second point, the first one is just talking about finance lease in general, something we know already. Read from point 2.
Okay. Contrary to installment sales agreement, the parties involved in finance agreements include the lessee and the lessor. Under finance lease agreements, concept of substance over form is applied to give the sole rights to the lessee to enjoy capital allowance on the leased assets. Unlike installment sales agreements, finance lease of transactions is not treated as sales of assets, and therefore the Commissioner General shall not treat the cost of the assets as cost of trading stock disposed of by the seller, and the sales revenue as income in respect of the seller. Contrary to installment sales agreements, the lessor shall, in ascertaining the income, okay, I don't know if there's an error.
Where?
The lessor shall, in ascertaining the income of the lessor for a year of assessment, include the whole amount of the interest and repayments of capital for that year as income in respect of the leased assets.
Yes, there's nothing wrong with it. I think we've discussed finance lease. Yeah, finance lease. So we know under the finance lease, the right and ownership, the risk and ownership of assets is transferred to the lessee. Is that not it? Under the finance lease,
Yes, please, that's it.
Yes, the right, the risk and ownership of the asset is transferred to the lessee. So in that case, what the treatment? Let me find out what the treatment. We have two parties, the lessee and the lessor. The lessee will use the asset and enjoy capital allowance on the asset. So the cost of the assets will be added to the cost of the depreciable assets of the lessee, and capital allowance will be calculated. Now, let me find out what the treatment, what the treatment of the lease, finance lease under the tax principle. Let me find out. Who is speaking? This day, if I'm talking plenty to not help, I think we have to contribute. Doris, we cannot hear you, so kindly. Oh, Sister Doris, your network, we cannot hear you, we cannot hear you. Say fast, what the treatment, the finance list, what the treatment? That's what you write and get your mark. Oh. That's what they're asking you here. That's what you write and get your mark.
Whose treatment, the lessee or the lessor?
You have to say the two. You have to say the two. You have to say the two. Both the lessee and the lessor.
Okay, so the lessee, as you said, will recognize the asset
The
in
right
his
of
book.
Yeah,
the right of book used in his books, and depreciation will be charged, and there will be an interest payment on the lease.
Okay.
So the interest payment will be subtracted from the profit before tax will be charged.
Okay. All right. And the interest will be subject to withholding tax. That's it.
Yes.
Okay. Then the lessor, how will the lessor treat the asset?
So the lessor will receive an income.
Okay.
That is the interest income from the leasing.
Mhm.
And that interest income is taxable.
What about the okay? I don't want to talk about the. I want to ask about principal payment, but this one is a lease. So, but the lessor receive principal payment from the lessee. Is that not it?
Yes.
When you lease an asset, they will be paying you on yearly basis. Depending on agreement, it can be on monthly basis, semi-annually or annually basis. You receive
Yes, but the entire lease payment is not deductible.
the entire lease payment is not deductible.
Yes, that is the principal repayment. That one is not deductible. It's only the interest portion that is deductible.
Are you talking about the lessee or the lessor?
The leasing.
We are done with lessee. The lessee there, you recognize right of use. So you recognize the assets and enjoy capital allowance on it. Then the interest payment is deductible. So I'm talking about the lessor. The lessor, you don't have the assets, so you cannot recognize asset and enjoy capital allowance. No. So you receive both your principal payment and the interest. Is that not it?
Yes.
So what will the treatment
That
be
will be recognized as a revenue to you.
as a revenue to you? And
Yes.
which will be subject to tax.
Yes.
Okay. So that's the contrary to installment sales agreement, the lessor shall, in ascertaining the income of the lessor for you, include the whole amount of interest and repayment of capital for the year of assessment as income. So the lessor, both the interest and the repayments or the capital repayments, you have to include it. You have to add it to your chargeable income, which will be subject to tax. All right. Now, operating lease. What the operating lease? Aunt Agnes, read the operating lease for us.
Okay, please. According to Section 4 of Income Tax Amendment Number 2, Act 2016, Act 924, a lessor who leases an asset under an operating lease shall, in calculating the income of the lessor, include the whole amount of rent paid under the lease. The lessor may be granted capital allowance with respect to the assets in accordance with the third schedule. The lessee shall deduct the rental payment from the business income of that lease.
Okay, so the lessor, under the operating lease, we know that the right of use, the risk of ownership of the asset is not transferred to the lessee. So the lessor will still be in possession of the asset. In that case, the lessor have to include what? Have to include the whole amount of rent paid. Is there any interest on in operating lease?
No. Rental payment.
There's no interest, so it's the rental payments. Is that not it? So the lessor have to include the rental payments in the income. Then the lessor will enjoy capital allowance because the assets will still be in possession of the lessor. So lessor enjoy capital allowance. Then what about the lessee? So the lessee, you are allowed to deduct the rental payment from your income before you pay tax. So in ascertaining the chargeable income of the lessee, the rental payment should or must be deducted from the income of the lessee. Now, which of the three options will be the best one that King Rose Limited should use to acquire their motor vehicle? Which one will you suggest for them? I think that's the requirement. That's the second one. Advise management on the best option on taxation grounds. So which one would they go for? Should they go for the installment sale of the asset, operating lease, or finance lease? Which one should they go for? Auntie Agnes, read the advice. The advice I put here. Read it for us. Let's see.
Okay, please. Going for operating lease will deny Kinross Limited from enjoying capital allowance. However, installment sales and finance lease give the right to Kinross Limited to enjoy capital allowance. Capital allowance reduce the amount of tax payable to the state. All the three options will give Kinross the right to deduct interest from the business income, which equally reduce the amount of tax payable to the state. However, under the operating lease agreement, Kinross can deduct all the rental payments as interest, which is more than the combined interest and capital allowance under the installment sale and finance lease. On the basis of this, Kinross shall opt for operating lease, holding all other factors constant.
Do you agree with my advice? The advice I put here. Do you agree with it?
Yes,
Are you sure?
yes, please.
The fourth point. Under the operating lease agreement, Kinross shall deduct all the rental payments as interest. Is that not the case? So, operating lease, the leasee, you're allowed to deduct the rental payment from your chargeable income before you pay tax. So when you that will be more than both the interest and capital allowance that you are going to pay under the installment sales and the finance lease. So in that case, they have to go by the operating lease. They have to go by the operating lease. Even though under the operating lease, they won't enjoy capital allowance, but the total rental payment will be deducted as interest. So it is advisable for them to go with the operating lease option to buy their motor vehicle. All right.
Use some figures to demonstrate that.
I have to use some figures to demonstrate that.
Uh,
If you let's say they rent the motor vehicle on a finance lease. I'm coming. Just use some figures to demonstrate that. All right.
no, you can just be saying it, not necessarily writing it.
I should just be saying it.
Yeah, let's say so. You say 30,000.
So let's say they rent the motor vehicle 30,000. That's operating lease. And let's say for 3 years. For 3 years, every year they are paying 30,000. Is that not it? So the total value is 90,000, but they are renting it for 3 years. So every year they are paying 30,000. And at the operating lease, that the whole of 30,000 will be deducted from their chargeable income before they pay tax.
Yearly.
Yearly.
Okay.
The rental payments will be deducted.
All right. So let's go to.
When you come to the finance lease, the same 30,000. The rental payment, let's say the total value of the lease is the 90,000, still 90,000. But they are going to be paying 30,000. First of all, they will pay interest. The finance lease, definitely there will be an interest portion of it. Is that what it is?
Yes.
So let's say the interest rate is 8%.
10%.
10%. That's the rate implicit in the list. Is that what it?
Yes.
In the leases, if you don't have that rate, then you use what? You use the incremental borrowing rate of the leasee. Is that what it?
Yes.
So let's say the rate is 10%. So every year they will pay interest of what? 3,000.
Yes.
Okay. So that interest will be what? Will be deducted. But under the operating lease, the finance lease, they will not deduct the 30,000 as rental payment too. They only enjoy capital allowance on the 30,000. Is that what it?
So that capital allowance will be what?
The capital allowance, that's motor vehicle. Which class is that?
75,000.
What is 75,000?
Class 2.
Motor vehicle is class 2.
Yes.
So, okay, you limit it to 75,000. Is that what you're saying?
Let's go.
Okay, so now the value is 30,000. So okay, so it's 90,000. So you limit it to 75,000. All right, you are right. So
So it depends on the type of car is it.
they say motor vehicle. Okay, based on the type of car is it. But in this case, we are assuming it's motor vehicle, so it cannot carry up to 13 passengers. So let's limit the value to 75,000 every year. That's class 2 at what rate? 30%.
That's 0.3.
That's 0.3. So capital allowance
Yes.
every year will be what? 0.3 multiplied by 75,000.
22,500.
So you will see that they will only deduct 22,500 plus what? Plus the interest, which is 3,000. Is that not it? That will be
25,500.
500. When you compare
Okay.
that one, that is both the interest plus the capital allowance. And the operating list, they are deducting the 30,000. They are deducting the whole 30,000. Is that not it?
Yes.
So you see that they will be deducting more. Their tax payable will be lesser under the operating list as compared to the finance list.
All right, that's great.
So they should go by the operating list. All right. Are we on question 3? Yes. So C. This question, if you see it first in the exam, how will you answer it? Charlie. That's AG. So
which one? Let's see.
No, the one we just discussed.
Issue. The matter.
But we'll get our 50 marks. Inshallah. Our
Inshallah.
50 marks there, we'll get it. The C, the income of NGO are exempt from tax. Discuss factors that can limit this tax policy. I want you to give me the first one. There is one that we normally discuss. Under the principle, we learned that an NGO, if you engage in a business activities which is different from your core business operation, the income you get from the other business activities you have engaged in, apart from your core business operation, would that income be exempted from tax? Yeah, so you pay tax on that income. That's the first one. That one, write that one first. That's the first one you have to write. Engaging in business activities, where NGO engage in business other than their core activities. The income they get from that business is be subject to tax. The legal constraint, when the legislating body make amendment to the sections of the Income Tax Act, the revocation of approval. So this one, at least the two, the legal constraint and the second one, engaging in business activities. The engaging in business activities, that's the first one you have to even write. Let's go to D. I have some nice question here. You have to differentiate between repairs and improvement for 1 mark. Then you have to briefly explain the extent to which this statement is true in light of what statement? What statement? The chief finance director of Atupan Manufacturing Limited has argued that the following expenditures are tax deductible under the Income Tax Act. Okay. So we have the expenditures: replacing new security doors of the factory building, 30,000 Ghana cedis. Then replacing distributing van engine, 19,500, 300. Then normal repairs on 2 of the office computers, 700,000 Ghana cedis. Then the total expenditure is 50 million Ghana cedis. So what's the differentiation between repairs and improvements? Let's go. What's the difference between repairs and improvement? Who is helping us? Which one enhance the operational efficiency of the assets? I'm sure one enhance the operational
Improvement.
efficiency of the assets and one does not.
Improvement.
Improvement. All right. Thank you, Senior. So improvement will enhance the operational efficiency of the assets. Repairs does normal repairs. Repairs does not does that. So now you are to briefly explain the extent to which this statement is true in line of the act. Now let me ask, what is the task treatment of repairs and improvement? What the task principle on repairs and improvement? If you don't know it, you cannot answer this question. If you don't know it, you cannot answer this question.
We'll calculate 5% on the.
Massa. Talk to me like you answer the question. You answer the question you answer. Which one you calculate 5%? You and who calculate?
So the repairs and improvement that will be deducted for tax purposes will be 5%. Will be a limit of 5% of the total repairs and improvement.
What are you saying?
I'm saying that the repairs and improvement that will be allowed for tax purposes will be to the limit of 5% of the total cost of repairs and improvement.
Are you sure?
Yes.
Oh, I don't agree with you. Auntie Agnes,
Yeah, so it will be limited to 5% of the written down value of the pool at the end of the period. And then the excess will be added back to the carrying value of the pool. And then capital allowance to be granted on the total. That's the excess plus the written down value.
Thank you very much. Sevas, is it the same thing you've said? I'll meet and talk to me. Let me hear you.
Me?
What you said, is it the same thing like what Agnes just said?
No.
Okay, so you see that your own is wrong. It's not 5% of the total cost of the repairs and improvement. No.
So 5% of the written down value of the assets in the pool.
Of the pool of the assets that asset belongs to. You see, the principle is very clear. Repairs and improvement is allowable deduction for tax purposes. So the principle states that whether the repairs and improvement is of capital nature or not, take note. Whether the repairs and improvement is of capital nature or is of recurrent nature or not, you subject it to the 5% rule. So the rule is that the amount of the repairs and improvement which will be allowable deduction for tax purposes shall not exceed 5% of the written down value of the pool to which the assets that the repairs and improvements was carrying out belong to at the end of the year, at the end of the basis of the year of assessment. So it's not 5% of the total value of the repairs and improvement, no. Now, looking at the Chief Finance Director's assertion that the following expenditures are deductible for tax purposes. What he's saying? Is it true? He is saying that replacing new security doors of a factory building. Is that repairs? You are replacing new security door of the factory building. Should that cost be capitalized or just it's a repair?
Should be capitalized.
Replacing new security door of the factory building,
We are replacing the door.
Yes.
It is a recurrent expenditure.
So you should subject it to the 5% rule. Is that not it?
Yeah. Yes,
Right.
please.
Replacing a engine. I said it repairs and improvement, whether of capital nature or not. You have to subject it to the 5% rule. Don't be confused. No. Repairs and improvement, whether the is of capital nature or not. No. The tax principle, you have to subject it to the 5% rule. So replacing distribution van engine to 5%, you subject it to the 5%. Then normal repairs on two of the office computers. That one too should be subject to the 5% rule. Good. So the last, I just want us to look at the last statement. We've said all the things here, we've said it already. The amount incurred to fix new security door, repair the computer, and replace the van engine shall be expensed to the extent that the expenses amount does not exceed the 5% of the written down value of 8 respective pools. Take note. All right. Let's go to E. Don't be confused. The principles are straightforward. Don't be confused. And I can read the question E for us. Let's see what they are talking about. Okay, this one, don't even read. State 4 reasons that may have triggered the change of in charge accounting date. I think we have discussed that. Changes in accounting date, reasons that may have caused an entity to change the accounting dates. And what are they?
Brother,
Yes, I can hear you.
before we go to that question you are saying,
Yes,
when we were learning imposition of tax,
yes.
there was some issue on repairs and maintenance or something.
Okay.
That there are some rules on, there's a rules on repairs and maintenance.
Okay.
And they say a repair to an asset that restores it to what it originally had been is not normally an allowable revenue expenditure. For example, the cost of replacing roofing sheets blow off by wind. Those repairs, no, why are we classifying it? Are we bringing them
That's what you said. That's the general rule. You see, the deduction rules, they are in 3 categories. You have the general deduction rules. You have the specific deduction rules. The principle is that the general ones are there. The general ones are there. Like what you just read. It's a general deduction rule. But the specific deduction rules supersede the general deduction rules. So in learning the tax principles, you are supposed to learn the general ones too, but more attention to be paid to the specific ones. Are you getting me, my brother?
I'm following.
More attention should be, or your focus should be on the specific deduction rules. They supersede the general deduction rules. If you have a deduction rule like the repairs and improvement, what we said is there, it's in the general deduction rule. But when you come under the specific deduction rule, that is where you have the 5% there. Well, that's where you have the 5% rule there, the 5% limit there. So that one supersede what you are saying, the general one you are saying.
Because anytime repairs and improvements or repairs, anything repairs is mentioned, my mind goes to that one. And I'm using that one.
That is the general one. Let me even get that note for you.
I have, okay, you can share with my colleagues, but I have it here.
Let me share so that you learn at once. It's under what? What?
Imposition of tax.
Imposition of tax, yes. Let me see if I can get that note. Imposition of tax and company taxation. Okay. I will not.
So that's the last. That's the last part of the general rules. No. You are going too far.
So I should go up.
Yes.
So that's the last part of the
general rules.
That's the one you are saying, the general. It's is it this one?
Go up small.
Small.
Yes, this one. No.
Is it initial?
So starting from here. Yeah, starting from there.
Mention the topic for me. The heading.
So initial repair expenditure on assets purchase. Then under that one we have other rules on repair and maintenance.
Yes. Okay. So the first one here, a repair to an asset that restores it to what it originally had been is normally an allowable revenue expenditure. All right. So these are general rules. These are the general rules. These are the general rules. The specific ones supersede. So so you see the specific deduction rules. They supersede the general deduction rules. You see, I'm sure it's even here. I say the last paragraph here. Also, this specific deduction will take precedence where more than one deduction rule applies. Are you okay, my brother?
Okay.
Are you okay, my brother? So don't confuse yourself about the general ones. Your focus will be on the specific deduction rules. And under this one, I think we have the repairs and improvement down there.
Yeah.
Here. I'm sure my screen is showing. You see, so however, the expenses for repair or improvement or depreciable assets that meets the requirements of being wholly, exclusively, and necessarily incurred during the year in the production of income from business or investment may be deducted, irrespective of whether they are of what capital nature. However, the deductions granted for the repairs and improvement for a year of assessment, one, shall not exceed 5% of the written down value of the pool at the end of the year and are allowed in other in which the expenses are incurred. So this one take precedence to the general one. This one take precedence to the general one. Okay. All right, let's move on. If you have any question, you are free to ask. So state 4 reasons that may cause change in accounting date. One.
When there is a merger or acquisition.
And what happened?
And that the parent company wants the subsidiary company to have the same accounting period with them.
Okay. So that's one. I had two. All right, let's go to question B. So let me see if I have all there. Have you a question 4 already? So
no, we're on the last part of question 3. Yeah.
So the need to synchronize the accounting dates of a subsidiary with that of the holding company for convenience of stock taking at a particular period of the year. A business may take over the operation of another, and as a result, may need to change the accounting dates of the company, taking over to that of its own to conform to a regulatory requirement. So take note of them. Very, very important. Take note of them. Question 4. A, you are to advise management of Bogosu Limited on the tax planning options available to minimize the effect of making Kumi Limited a subsidiary. So the question is, Bogosu Limited is a UK insurance company intend to make Kumi Limited its subsidiary in Ghana. All right. So Kumi Limited Ghana has been making huge losses for some years now. So because of that, Bogosu Limited has 3 key. Okay, because they are making loss. So because of that, Bogosu Limited want to make them their subsidiary. So Bogosu Limited had 3 key managers that can turn Kumi Limited into a profit-making insurance company. Now, you have to advise the owners or management of Bogosu Limited on the tax planning options that they can use to minimize their tax liability of making Kumi Limited their subsidiary. So what are the tax planning measures? First of all, do you
No
understand?
allow-
Who is talking? Auntie Agnes.
Yes, sir.
You were saying something.
Yeah, capital allowance is one.
Capital allowance is one.
Tax holiday, tax exemption, tax refund, and then tax relief.
So are you going to write them like that? This is 6 marks. Oh.
Explanation there is between pen and paper. Oh.
But what you're saying, I'm a little bit confused about them. If you can explain to me, because the question, a company want to make another company their subsidiary, but that company, Bogosu, is not a resident company in Ghana. No, it's a UK company. It's an insurance company in UK. So they want to make a Kumi Limited. Kumi Limited is a guy. It's a company in Ghana. So a non-resident company want to make a resident company its subsidiary. So what are the tax measures available for the non-resident company to make making the subsidiary, which is a resident company in Ghana? So if it's a capital allowance, I don't get it unless you explain to me. Auntie Agnes.
Maybe I gave a wrong answer.
I was thinking about issues of transfer pricing and stuff. And that is the only one that is in my head, transfer pricing. And maybe issues of team capitalization and
That was what you were thinking about.
yes.
Okay.
But I don't even know how I'm going to explain it to make a point.
Okay. Let's start this way. When Bogosu Limited makes Kumi Limited its subsidiary in Ghana, it means that the Bogosu Limited will not be transacting business with Kumi Limited in Ghana. Bogosu Limited is not a resident company in Ghana. So that system of your subsidiary, how is it termed in taxation? You are
That's
not
doing business with a country, well, with Ghana. Let me put it like that.
yeah, because you have doing business with Ghana.
Yes.
Doing business with Ghana. That term is two. You have trading with Ghana and trading what?
In Ghana.
With and in. Is that not the word?
Yes.
And Auntie Doris, your device is giving us a feedback. Your device is giving us a feedback. Auntie Doris. We have trading in Ghana and trading with Ghana. Which one is taxable in Ghana?
Trading in Ghana is taxable.
Okay. So if you have a subsidiary in Ghana, will it be deemed as trading with Ghana or trading in Ghana? The principles are many, so you have to do your best. Taxation, the paper, you may seem it to be easy, but Charlie, if you don't, the principles are many. If you don't know the principles, it will over you. It will over you. The principles are many. You have to know the principles. Trading in Ghana and trading with Ghana. Which one is taxable in Ghana?
Trading in Ghana is taxable in Ghana.
Okay. And trading in Ghana, there's a name for it in taxation. How is it called?
Permanent establishment.
Exactly. That's what I want you to say. That is permanent establishment. So this one, when you have a subsidiary in Ghana, it's a form of permanent establishment. It's a form of permanent. So let's learn one thing before we move forward. Today is revision. We are just revising everything. We are refreshing our mind. What is the taxation rule on permanent establishment?
Oh, you just be taken as though you are a resident person and
Okay.
you pay tax as any resident person is paying.
All right. Thank you very much. Thank you very much. And any transaction between the owners and the permanent establishment will be subject to what? To the arm's length principle. Is that it?
Principle,
It
yes.
will be deemed as transaction between persons that are in control relationships. So the arm's length principle must be their transaction must be subjected to the arm's length principle. All right, good. Now, let's come to the question. It's good we refresh our mind on permanent establishment. And let's give, we don't know where the question will come from. Examiners like asking questions on permanent establishment. I think I even have a question on it in the notes, but let's refresh our mind. There are some activities that are deemed as creating a permanent establishment in Ghana. What are some of those activities? So they can ask you to give examples of activities that create permanent establishment in Ghana, at least 4.
So when you are a foreign country, foreign entity,
Uh-huh.
and you are undertaking a contract in a country which will expand for more than at least 90 days,
Okay.
you'll be regarded as a permanent
So
establishment.
long-term contract that lasts for more than 90 days will be deemed as creating a permanent establishment. Okay,
Yes.
that is one. Subsidiary is one. Subsidiary company is one. Is that not it?
Making 2.
Foreign
entity registered in Ghana or incorporated in Ghana.
Okay, and a place in Ghana for provision of services. Should I go to that note?
And agents, it seems agents too.
Let me go to that note so that we learn that one too at once. Let's refresh our mind. Let me look for that one too. Then
that's under international.
It's under international taxation.
Yes, and transfer pricing.
Okay. Let me look for that one so that we learn at once. We refresh our mind. Okay. So permanent establishment. And don't forget, we have 2 types of permanent establishment. We have Ghanaian permanent establishment and what? And foreign permanent establishment. So what's the differentiation between the two?
So foreign permanent establishment is when a resident person establish a business outside Ghana.
Okay, so you are a citizen of Ghana, you go and open company in Nigeria.
Bam.
So that will be deemed as a foreign permanent establishment. Is that one, is it subject to tax in Ghana?
No.
All right. So the Ghanaian one, that one is subject to tax in Ghana. So that one, if you are not a citizen of Ghana, you come and establish a place of business in Ghana. That will be deemed as a Ghanaian permanent establishment. That one is subject to tax in Ghana. So these are the activities. So one, a place in Ghana where a non-resident person carries on business or that is at the disposal of the person for conducting business. A place in Ghana where a person is using or is installing substantial equipment or substantial machinery. A place in Ghana for the provision of services. Normally I put the short ones in my mind. Then you will be able to write those ones first. A place in Ghana for provision of services. The place in Ghana where a person is engaged in a construction, assembly, or installation of project for more than 90 days, for 90 days or more. Then a place in Ghana where an agent performs any function on behalf of the business of a non-resident. Yes.
This is what I was saying.
Good. All right. So thank God we have refreshed our mind. Okay. So let's answer our question. Let's move on to our question. Good. So in making a subsidiary, which will be subject to a permanent establishment, what is the tax planning measures available to Bogos Limited? So I have some suggested answers here. Auntie Agnes, read what I've written here. If Auntie Agnes is on the call.
Yes, sir.
Okay.
Let's start from the A part. Or
Yes, we are starting from the A. Is the A we are answering? Is the A we are answering?
okay. A company becomes more than 50%. There is tax implication on acquiring more than 50% of a company if not properly planned. Provide that where the underlying ownership of an entity changes by more than at any time, at any time within a period of 3 years, the assets and before the change is deemed to be in subsection 2 of Act 896 provides that the entity that changes by more than 50% within 3 years period cannot deduct an unrelieved loss under section 17 subsection 1 that was incurred by the entity before the change. Deduct financial costs carried forward under
Okay.
section
Auntie Agnes, let me help you. You see this question. You see the angles you started missing from capital allowance and things. Zero cry you not even get. Auntie Agnes, are you hearing me? Yeah.
yes.
Yes, zero cry you not get. This one they are testing you on changing ownership because you want to make a company your subsidiary. So before you make a company your subsidiary, it means you have more than 50% of what? Of the ownership of the company. Is that not it? Before you can consolidate a subsidiary, unless you have more than 50%, or there are some special some instances whereby you may not have up to 50. But if you have a major controlling interest in the subsidiary, you can consolidate. Or you say you have a significant influence. But in this case, before the company will become your subsidiary, it means that you have more than 50%. And there's a tax implication on acquiring 50% of a subsidiary, of acquiring 50% of ownership of another company. So the principle is that if the ownership changes by more than 50% within 3 years period, take note, we spoke about this thing earlier. If the ownership changes by more than 50% within 3 years, 1, 2, 3 years, you're able to acquire more than 50%, it means that the company that the ownership has changed by more than 50%, you cannot deduct these specific items. Any unrelieved losses, you cannot deduct it. Financial costs carried forward, you cannot deduct it. Bad debt, you cannot deduct it. Losses on long-term contract, you cannot deduct it. So what will be the tax planning measure here for Bogosu Limited? So the tax planning measure will be that Bogosu should spread the acquisition of more than the 50% should be more than 3 years. If it is more than 3 years, the financial costs, you still deduct it. Unrelieved losses, you still deduct it. Bad debt, you still deduct it. But if the changes by more than 50% occurs within only 3 years, the principle, you cannot deduct those your losses. You cannot deduct them. So the tax planning measure here is that Bogosu Limited should spread the acquisition of more than 50% of Kumi Limited for a period to be more than what, 3 years. That's all. If you're able to do that, then they'll be able to enjoy the unrelieved losses that Bogosu, that Kumi Limited was making. Any financial costs that they've carried forward within the 3 years will also be what? Will also be deducted. Any bad debt will also be deducted. Now, let's remind ourselves on this principle. What is the tax principle on financial cost and financial gain? What the tax principle of financial cost and financial gain? Like, I want us to finish this question so that we'll do this general review, but from the look of things, we will not have the time. So we'll be doing it in between. We'll be discussing it in between the questions.
I think this one to calculate 5% on adjusted profits of the
Which one?
company.
Which one too?
The financial cost and the financial gain.
I'm not asking how will you do it. I say, what is the principle on it?
I was thinking the financial loss will be deducted to the extent of the gain recognized.
Auntie Agnes, are you done?
Yes, please.
Yeah, what you said, that is peculiar to which sector? Let me know if you say it.
Hey.
The financial cost deducted to the extent of the financial gain is one of the principles, but it's peculiar to only some specific sector. That is not the general one, no. It's peculiar to some industries that fall within some specific sector. Auntie Agnes. What is in the chat box? Can you still increase your volume? Is it the same thing?
No, it's a petroleum and mining industry.
Exactly. Who is that?
Dell.
Thank you, Dell. It's peculiar to petroleum and mining industries. That is it. But I want the general one, the general principle. Like I said, I want us to finish the question so that we'll go back and do these principles, take the one, but we will not have the time. So we'll be doing it in between the questions. And if anyone that crossed my mind, we will discuss it. First, you were saying something, you will do 5% of what?
Of the adjusted profits compared with the financial gain and the limit to which the financial cost.
Martha, what are you saying?
I'm confused. I'm saying that you compare the financial gain to the 5% of the adjusted profit.
Financial cost or financial gain?
Financial cost to the 5% of the adjusted profit. That part, no. You compare the one which is higher.
Masa, you better keep quiet. Somebody is saying something in the chat box. What is that? Can I see that? Dory, 50% of adjusted chargeable income plus financial gain. Exactly. Doris, thank you very much. So the general principle is that financial cost is what is allowed to the extent of the sum of the financial gain plus 50% of the adjusted chargeable income. Now, in calculating the adjusted chargeable income, you calculate it without including the financial cost and the financial gain. Should I take it again or it's okay?
No, take it like 2 times.
Okay. The general principle. Financial cost is allowed to the extent of the financial gain plus. So it means the financial gain plus 50%, 50% of the adjusted chargeable income. Now, the adjusted chargeable income is calculated without including the financial cost and the financial gain. Then the excess is carried forward for the next what? For the next 5 years. You carry the excess of the financial cost that is not allowed for the year of assessment due to the limit rule. You carry the excess forward for the next 5 years. For the next 5 years, you should be able to make a financial gain and deduct the excess financial cost that is not allowed. For the next 5 years, you carried it. And you deduct it on first in, first out basis. I'm sure that principle is well cleared now. Cephas, are you okay? Auntie Agnes, are you okay?
Yes, please.
Okay. So we are done with the A part. So Bogosu Limited can what? Have to spread the acquisition of shares over a period such that the change in ownership of Kumi Limited will not be within 3 years. Will not be within 3 years. In that case, the unrelieved losses that Kumi Limited was making, any financial cost that was carried forward, any bad debts, all of them can still be what? Can still be deducted. Can still be deducted. B part. Let's move on to B part. We didn't start the class early, so I'm sure you guys, you don't have any other class again. So at least let's finish the question 4 before we close. Or if you like, yes, I can hear you, Senior.
Sir, please, the period within 3 years.
Yes.
Is it period, the incorporation period or what?
No. It's not incorporation period. No. It means, you see, acquisition of shares.
Yes, sir.
Acquisition of shares. If you are able to acquire 50%, if the ownership of the company change by 50%,
yes,
you will see that the company becomes your subsidiary. So you can consolidate the subsidiary. Is that not it?
Yes, sir.
Now we have another one, step acquisition. Step acquisition. That one, step acquisition, you are not able to acquire the 50% at a go. So you acquire your 50% in stages. So what the principle is saying that if the acquisition, you acquire your 50% within 3 years. If you
Yes,
acquire
sir.
your 50% within 3 years, it's not talking about the time of incorporation of the company, of the subsidiary. No. If within 3 years you acquire the 50% of shares in the subsidiary, it means that any financial loss carry forward, any unrelieved loss, you cannot deduct them. The subsidiary cannot deduct them again. That's the principle. That's the principle. But if you're able to spread the acquisition of the 50% for a period more than 3 years, maybe you use 4 years or 3.5 years to acquire 50%, still the unrelieved losses, financial costs carried forward will still be what? Will still be deducted. You know, your unrelieved losses, financial costs carried forward, bad debts, all this one will reduce your tax that you are supposed to pay.
Yes, sir.
So the acquisition is the period of the acquisition.
Oh, okay.
It's the period of the acquisition of the shares, which will amount to the 50% of change in ownership. That is what the principle is talking about.
All right. Okay.
So if you stand up at once, you acquire 50%. Oh, that one there, at a go, you acquire 50%. Then it means that one is even within its one-time acquisition. So that case, all financial costs carry forward and relieve losses, you cannot deduct them again.
Okay.
So the company,
So it should fall within the 3-year period. Within the 3-year period, you cannot make that deductions.
you cannot make those deductions, yes.
But if it falls beyond that 3 years, you can make deductions. Okay.
Exactly. When the acquisition falls beyond more than 3 years, you are allowed to make those deductions.
Okay, thank you, sir.
Thank you very much. Thank you very much. If you see this question, you were told that Kumi Limited is what has been making huge losses for years now. For years now, they have been making huge losses. So if Bogoso Limited should just go and acquire 50% one time, all those losses, Kumi Limited cannot deduct them again. All those losses, Kumi Limited cannot deduct them again because the change in ownership, which is more than 50%, is acquired at a go, just a one-time acquisition. So Kumi Limited cannot deduct the losses. In that case, Bogosu Limited should what? Should plan the acquisition of the 50% should be more than 3 years. When they do it like that, Kumi Limited can go ahead and deduct the huge losses. So in the first year, they can decide to acquire maybe 15%. Second year, they'll acquire 20%. That'll be 25%. Third year, they acquire what? Maybe 10% again. That'll be 35%. Then in the fourth year, they can acquire the rest 15%. In that case, Kumi Limited can still be deducting what? The losses. Let's move on to B. Auntie Agnes, read the option B for us.
B. Sulemana PLC.
It's now close. Should we continue? Me, I want us to finish with up to question 5 before we. What's the suggestion of the class? Because we didn't start early, so that also affected us. What is the chat box? Dale, you say yes. That means we should continue. Say 11. I don't say 9:30. Dale is say 11. Okay. I think we can continue. So let's move on. Auntie Agnes, read the question B for us.
B. Sulemana PLC, a UK-based manufacturing company, is planning to build a new processing facility branch in Ghana. The chief executive officer, in a meeting with management, needs to decide whether to site the facility in Koforidua or Tema. Koforidua is capital of Eastern region of Ghana, and Tema is Tema is a city in Greater Accra region of Ghana. Market intelligence
Auntie Agnes, your network. So if you are reading, we cannot hear you.
has no
Hello. Hello.
Auntie Agnes, are you not reading? Somebody is calling me.
I can't hear anything, so I thought it's my network, so I was calling.
Auntie Agnes, it's like maybe
She's not on the call.
Okay, so who will continue reading for us? We'll come back. Somebody said, Chama, we are corporate at 3. Corporate at this dawn, actually. The 11 will be too much. So let's do maybe up to like 9:30. Then we can close. So that guys, you can have some rest before 3:30. Then you start your corporate reporting. Okay. So Sefat, read the question. Read the question for us.
From where?
What are you laughing at?
Sulemana PLC.
You're laughing at Sulemana.
I'm reading, please.
Okay.
Sulemana PLC, a UK-based manufacturing company, is planning to build a new processing facility branch in Ghana. The chief executive officer in a meeting with management needs to decide whether to site the facility in Koforidua or Tema. Koforidua is capital of Eastern region of Ghana, and Tema is just a city in the Greater Accra region of Ghana. Market intelligence has no preference for citing the facility in any of the places, since information gathered indicate that business activities would largely be same in the two places for the next 40 years. The following forecast information is available for the decision-making process being considered by management. Receipts and expenditures, Koforidua Tema. Additional information. 1. Factory building, plant and machinery, equipment and motor vans will cost 3 million, 1 million, 1.5 million, and 500,000 respectively. 2. Sulemana PLC intends to depreciate the asset over 10 years period. 3. The proposed depreciation charges for year 1 has been included in the proposed production cost. 4. It is the policy of Sulemana PLC UK to finance the new processing facility with a loan amount of 10 million at interest rate of 5%. You have been contracted as a tax expert to help the company plan where to site its branch in Ghana. Required. 1. Explain the deductibility of interest and any possible foreign exchange loss incurred on the loan under the Income Tax Act 2015, Act 896. 2. Compute Sulemana PLC's net repatriated profit for each proposed location for the first year of assessment. 3. State where Sulemana PLC is likely to site the branch in Ghana. Justify your answer.
Okay, thank you very much. So the first requirement, you have to explain the deductibility of interest and any possible foreign exchange loss incurred on the loan. Okay, so this requirement, what is the examiner testing here?
Think capitalization.
In capitalization. So what will be your explanation? It's for 3 marks. So what will be your explanation? The company, they want to take a loan to finance their new processing facility. Excuse me, 10 million Ghana cedis, and they'll be paying interest at the rate of 5%. Now, this interest will be subjected to the team capitalization rule. So in the team capitalization rule, the interest deductible should not be more than the debt to equity ratio of 3:1. Now, in this question, the business, we don't have any equity as the capital structure of this company, of Sulemana PLC. Do you have any equity in the question?
No.
We don't have any equity in the question. So in that case, the interest of how much? The interest is, that will be 5% of the 10 million. That will give 500,000. That interest cannot be deductible. Will it be deductible? Will the interest be deductible? While you are subjecting the interest and any foreign exchange loss to the team capitalization rule, is the equity over the debt multiplied by the interest payment. Is that not it?
Yes.
Or multiplied by the foreign exchange loss. Now the equity is 0, so that will be 0 over what? Over the debt.
Over debt.
What will it give you? So everything will be 0, so you cannot deduct. No portion of the interest can be what? Can be deductible, because the equity is 0. There's no equity, so the interest cannot be deductible. Because the numerator will be 0. So that will be 0 over the over 10 million multiplied by
10 million.
Multiplied by the 500,000. What will you get?
It will give you 0.
It will give you 0. So it means that the interest or 500,000 on the loan cannot be tax deductible because the company will be financed, the thing will be financed by only debt. There is no equity. So when you are subjecting the interest payment to the thing capitalization rule, to the 3:1 ratio of debt to equity, there are no equity. So the interest cannot be what? Cannot be deductible. So
Wow.
you say what? Now let's compute the net repatriated what? What's the requirement? You have to compute the net repatriated profit for each proposed location for the first year. 9 marks. Very good marks. This one can we push you to pass the paper easy? Because this one is simple. I hope you guys were able to do this one. Why are you not able to do this one?
Yes.
So this one is very simple. So this 9 marks will help you to pass the paper. Very simple. So let's see what I have done. So we have the expected gross receipt for the both locations. Then you deduct your payroll expenses, you deduct your production costs. Then you have profit before tax. What again? Now, we were told that additional information one, factory building, plants and machinery, equipment and motor vans will cost 3 million, 1 million, 1.5 million, 500,000 respectively. So Sulemana PLC intends to depreciate the assets over 10 years. So, and the proposed depreciation charge for year one has been included in the what? In the proposed production cost. So the depreciation charge for year one has been included in the production cost. So Kufridia, the production cost is 1.8 million. The total depreciation on factory building, plant and machinery equipment and motor vehicle has been included in the cost. So what do you do?
We add back depreciation.
You do what?
We add the depreciation back.
You have to calculate depreciation and add it back. Why are we doing that?
So that the depreciation that is subtracted, we added back, then we calculate capital allowance and subtract it instead of the county depreciation.
According to the tax principle, depreciation is what is the name, the applicable name for depreciation? Depreciation is what type of expenditure? Yeah, let me ask. We have some expenditures that are not allowed deduction for tax purposes. We have depreciation is one of them. Penalty and fines. If you violate any tax principle, you pay penalty. You will not deduct it. The penalties and fines and depreciation, there are some categories of expenditure under the tax principle. They are what? Excluded expenditures. Is that what it is? They are classified as what? Excluded expenditures.
Excluded expenditures.
Yes, excluded expenditures. Then we have the domestic expenditures too. So depreciation, you add it back. So in this case, depreciation was included in the production cost. So you must compute the depreciation and disallow it. Then in place of depreciation, you compute capital allowance and deduct the capital allowance. So how do you calculate the depreciation? So I've done the calculation here for you. Building, they said their depreciation policy is over 10 years. So that's straight line. All of them 10 years. So building 3 million divided by 10 years, that will be depreciation for year one. Plant and machinery, divide the 1.5 million by 10 years. Equipment, 1 million divided by 10. The motor van, 500,000 divided by 10. So total depreciation will be 600,000 Ghana cedis. So that will be applicable to the two locations, both Kufridia and Tema. So you add the depreciation back, then you now have your adjusted profits. So you have to compute your capital allowance and deduct your capital allowance. Factory building, which class?
Building class 4.
Class 4. And depreciation is on capital allowance is what? 10% on straight line basis. Then plant and machinery, which class? This is why I'm also enjoying the revision part. We will use it to learn, revise the whole thing. Plant and machinery,
Class 3.
class 3. So this one to be class 3. Is that not it? Who said class 3? Who said the class 3?
Yeah.
Dell. Plant and machinery, I think there are two rules on the plant and machinery. First, if the plant and machinery is used in manufacturing, plant and machinery used in manufacturing is class 2. So what you do is you check the company. Is it a manufacturing company? If it is a manufacturing company, then if the company have plant and machinery, that will be class 2. But if the company is not a manufacturing company, then that's class 3. Then are you okay?
Yes, sir.
So in this case, will it be class 3 or 2?
Class 2.
Class 2, because the company is a manufacturing company. So plant and machinery will be class 2. Equipment is class what?
Class 3.
Class 3. The motor van.
Motor van, class 2.
Motor van, class 2. Motor van, class 2. The motor van is 500,000. So what do you do? Did I even include the motor van?
I don't know what you did, though.
Is that what?
I don't know what you did.
You don't know what I
Because your class 2 rather is 2 million. And I don't know what you put together 2 million.
Class 2, I have what?
You have 2 million. And I don't know what you put together.
Oh, are you sure?
It's not, I'm sure. The thing is showing you.
Class 2, I have 2 million. What is 2 million there? Why is it 2 million?
Maybe you added the equipment to the motor van and put them at class 2. Then you send the plant and machinery to class 3.
Oh,
Because
that was
that's the
what I
only
did.
justification too.
That was what I did.
That's the only
Equipment.
justification I have.
Who is talking? This will be big mess up. Oh. Is somebody saying something?
No.
I want to see what I've done. Capital allowance, class 2. First year of assessment. Factory building, plant and machinery equipment and motor van will cost. Okay, this is the cost. Anything concerning them again? No, class 2, why should it be 2 million? What have you done? This is your more question. What have you done?
What we have done is what we just enumerated to you. That yes, that's the class 2 will be 1,500,000. So that will be 1,500,000. Then class 3 will be also be 1,500,000. And class 4 will be 3 million.
Class 4 will be 3 million.
Yes.
Class 2 will be what?
1,500,000.
Class 2 will be 1,500,000.
Yes, that is the plant and machinery plus the vehicle.
Okay. Then class 3 will be what?
That one too is the equipment, which is 1,500,000.
Okay, that will be it. I'm sure that will be it. Because I'm not sure there's no other information in the question again. I'm not sure. So That will be it. Because this one there's no way it should be wrong. This capital allowance, no. It shouldn't be wrong because the thing is straightforward. The thing is straightforward. So what is your total capital allowance? What's your total capital allowance?
Let me calculate a new one for you.
The one you have done, why is it wrong?
It's not with me or me. I can't remember that thing.
Okay.
So that's 1,050.
1,050.
And 50. That's 1,050,000.
Okay. So that's the capital allowance. So that value will have to be deducted. So it means capital allowance here is wrong.
Yes.
Yeah. So capital allowance here is wrong. Capital allowance here is wrong. Right. So then the requirement is we have to calculate the net repatriated profit. So you deduct your capital allowance, then you now have your chargeable income or adjusted profit. So Kofredia, what would be the tax rate for Kofredia?
18.75.
18 because it's original capital, so 18.75. Or what of Tema?
25%.
So 25%. So you apply the tax rate to the chargeable income, then you have your end repatriated profit. So what is the branch profit tax? What's the rate?
Which one is that one?
The branch profit. That's all you have to calculate. You have to calculate net repatriated profit. The net repatriated profit. So that's what you are supposed to calculate. So there will be branch profit. We've discussed that. Have you forgotten?
Branch profit.
So that is 8%. Branch profit is 8%. So if you are a company, you have a subsidiary in Ghana, that the profit for the year will be repatriated to you. You are not a non-resident company in Ghana. You are a non-resident company, but you have a permanent establishment in Ghana. The profit that will be repatriated to you, that profit to you charge 8% tax on it. That's what you call the branch profit tax.
So that one too is economic double taxation. Okay.
Yes, it's also economic double taxation. Because this one, you have a permanent establishment in Ghana, and the profit to be repatriated to you. So you're not allowed the money to go like that. You still pay tax of 8% on it, even though you charge your permanent establishment at a corporate level. We still charge the branch profit tax 8% on your repatriated profit. So when you calculate the 8% and you deduct it, then the net, the amount to get to become the net repatriated profit, that will now be what transferred to what company is that?
Bogoso.
Bogos. Are you sure it's Bogos? It's not Sulemana.
Suleiman.
That will be transferred to Sulemana company in UK. That will be transferred to Sulemana company in UK. So is that the last requirement there?
Yes.
So, okay, you have to state where Sulemana PLC is likely to start the branch in Ghana. So, where's the likely place that they will site their company in Ghana?
Let's see the solution.
You want to see solution before you decide?
No, like it's okay, yeah.
Okay.
We will compare the two repatriated profits.
Okay. Yes, your decision will be based on the location that will give them the higher net repatriated profit. So that will be Kufuria. Is that not it? That will be Kufuria. So your decision will be based on the location that will give them the higher net repatriated profit. So that will be Kufuria. Okay. Question 5. Question 5 is on transfer pricing. Question 5 is on transfer pricing. Auntie Agnes, are you back? If you are back, read the question 5 for us. You have to finish question 5 today. You have to finish question 5. Who is reading for us? Who is reading the question 5 for us?
Question 5.
Okay.
Techno Ghana Limited is the Ghanaian distributor of Pronto brand laptop computers. It sources its stocks from its parent company, Techno International in South Korea. The only value added to the laptop computers by Techno Ghana Limited is the provision of English language instruction manuals and delivery to wholesale customers. The printing of the English instruction manuals is outsourced to an independent printing company based in Accra. In the financial year ending 31st December 2021, the price per laptop computer charged by Techno Ghana Limited to wholesale customers is 3,000 Ghana cedis. The cost per laptop computer to Techno Ghana Limited is 5,500, excluding the cost of the English language manual. The cost of adding the instruction manual is 10 cedis. There are 5 similar independent distributors of comparable laptop computers in Ghana in 2021. The independent distributors performed similar functions as Techno Ghana Limited. These distributors earned a 15% margin on distributing the comparable laptop computers. Required. 1. Outline 2 factors to be considered in choosing the most appropriate transfer pricing methods under Section 5 of the Transfer Pricing Regulation 2020 LI 2412. 2. Identify the most appropriate transfer pricing method to apply in this circumstance. For your answer, apply in this circumstance, give reasons for your answer and briefly explain how the method is applied. 3. Calculate the arm's length price Techno Ghana Limited should have received for the laptops from its parent company, Techno International in South Korea, by using the most appropriate transfer pricing method you identified in Roman number 2 above, and state the transfer pricing adjustments to be effected. 4. Briefly explain functional analysis and state its relevance.
Okay, so in this question, what transfer method will be most appropriate? We've discussed, we know all the transfer methods, pricing methods that we have. What are they? The first one is what? We have the resale price method. We have the cost plus method. How many are there? Are there 4 or 5? You have transactional net margin and transactional profit split. Which one again? Okay, like I remember the 4. Now, in this question, first one, you have to outline factors to be considered in choosing the most appropriate transfer pricing method. So what factors will you consider before you choose a transfer pricing method? So if I have the suggested answers here. So first, the respective strengths and weaknesses of the approved method, the availability of reliable information needed to apply the selected transfer pricing method, the degree of comparability between the controlled and uncontrolled arrangement, including the reliability of comparability adjustments, if any, that may be required to eliminate differences between them. Then the appropriateness of the approved transfer pricing method having regard to the nature of the control arrangement. So these four methods, you must take them into consideration, or they will determine the transfer pricing methods to apply. Now, the second requirement, you are to identify the most appropriate transfer pricing method to be applied in the scenario given to us above. So what transfer pricing method will be appropriate? In the question, we are told that Techno Ghana is a distributor of Punto brand laptop computers. So normally they get the stock of the computer from their parent company, Techno International in South Korea. So they'll get their goods from their parent company in South Korea and sell in Ghana. Now, the only thing that they does to the computers is to add an English manual to the computers. That's the only thing they do. And they deliver them to the wholesalers. The printing of the English instruction manual is outsourced to an independent printing company based in Accra. Now, so based on that scenario, you know that the transfer here is between the transaction between a subsidiary and what? And a parent company. So that transaction must be subjected to the arm's length principle. Now we are to determine the appropriate transfer pricing method to use. We were told that Techno Ghana normally charge what? The price per laptop computer charged by Techno Ghana Limited to the wholesalers is 3,000 Ghana cedis. Now the cost per laptop computer to Techno Ghana Limited is 5,500, excluding the cost of the English language manual. So the English language manual is 10 Ghana cedis per laptop. Now, there are similar distributors of the functions performed by the laptop supplied by the Techno Ghana Limited. And these distributors, they earn 50% margin. So this will even give you the transfer pricing methods, which will be applicable in this scenario. So which one will be applicable? Let's be fast. It's 9:30. I'm still in the office. Let's be fast so that we finish this question. Would the resale price method be appropriate here? Would the resale price method be appropriate here? Okay. Am I on the call?
I think that one will be good because we are buying and reselling. So
we are buying and reselling. So the most appropriate method is the resale price method. We are buying and we are reselling. So the resale price method will be more appropriate. Then you are to what? How the method is applied. So this one, so if I read how the method is applied for us, let's see. How it is applied, that's the resale price method.
okay. According to the first schedule of LI 2412 of 2020, resale price method is used to determine the arm's length range by comparing the resale margin that a purchaser of goods or property in a controlled transaction earns from reselling the goods or property in an uncontrolled transaction with the resale margin that is earned in comparable uncontrolled purchase and resale transactions. The method will be appropriate when one related party located in Ghana buys goods from its overseas related party and relates to customers in Ghana and resells to customers in Ghana, It is most reliable if the reseller sells within a short time because the longer the time, the greater the risks, such as changes in exchange rates, inflation, which also affects the price. Also, the method will be useful while the reseller does not contribute to the value of the product and resell the same product acquired from the related party to customer. The margin of Techno Ghana Limited derived from selling to independent customer in Ghana can be used as comparable factor to determine the profit and the arm's length price at which the control transaction should have been priced. To determine whether the related party price on the control transaction reflects arm's length, the Techno Ghana Limited margin on similar circumstances should be expressed on the selling price of transaction between Techno Ghana Limited and independent customers in Ghana. The profit ascertained should be matched with the selling price of Techno Ghana Limited in ascertaining the cost price at which the related parties should have transacted the consumable products.
All right. So we have to compute the appropriate price that will reflect the arm's length principle. So I've done the computation for you here. The selling price is 3,000 Ghana cedis. And there's the margin on it. The margin is what? 15%. So the margin is 15%. So you calculate the margin and the cost. The cost incurred to add the English manual, which is 10 Ghana cedis. You deduct it. So the transfer price will be what? 2,540. But when you look at it, they were making a loss. They were making a loss from the control transaction because they will buy it 3 million, they will buy it 5,500, add the cost of the English manual, which is 10 Ghana cedis to it, before they will now sell it at 3,000. So they are making a loss, or 2,510. But when you use the arm's length principle, the price will have be 2,540 because they are selling it at what? 3,000. There's a margin of 15% on it, then the cost will be deducted. So the transfer price should have been what? 2,540. That's the amount that's the thing should be transferred between the Techno Ghana Limited and the Techno what? International Limited. So giving it to the Techno Ghana Limited at 5,500, that is not the transfer price. That price is not appropriate. The transfer price should have been 2,540. So the 5,500, that is not the arm's length price. The arm's length price should be 2,540. What's the next requirement?
We should explain or not calculate the arm's length. Okay.
Okay. They briefly explain functional
analysis.
Okay. The B explain the taxation rules on trust beneficiaries. What are the taxation rules on trust beneficiaries?
The only thing I remember is they don't pay what.
They don't pay what? The rule is that if the distribution in respect of a resident trust, that distribution will be exempted from tax. But if the distribution is in respect of a non-resident trust, the distribution should be added to the income of each beneficiaries and taxed at the individual graduated tax rate. So the beneficiaries of the trust the trust itself is an entity. So it will be subject to tax as a resident entity, as a resident company. But the beneficiaries, the tax rule on the beneficiary is that if the distribution is in respect of a resident trust, the distribution is exempted from tax. But if the distribution in respect of a non-resident trust, the benefits that the beneficiary has gotten from the trust must be added to their income and taxed at the individual, the personal graduated tax rate. I think I've written something on it. So according to section 57 of Act 896, a distribution of a resident trust to its beneficiaries is exempt from tax. But a distribution of a non-resident trust is taxed, hence included in calculating the income of the beneficiary of the trust for taxation purposes. A gain on the disposal of the interest of beneficiary is in trust is also included in calculating the income of the beneficiary for tax purposes. So take note. If the distribution in respect of a resident trust, that distribution is exempted from tax in the hands of the beneficiaries. But if it is a non-resident trust, that distribution, that amount must be included in calculating the income of the beneficiaries for tax purposes. The last question, question C. If I read the question, the C for the option C for us.
C. Management of Bugum Limited decided to hire consultancy firm to help them plan their tax affairs since Section 18 of the Revenue Administration Act 2016, Act 915, makes provision for the use of a tax consultant by a taxpayer. Excellent professional consults were hired on 1st January 2021 to take charge of the tax affairs of the business. Going through the tax records of the business, the team of the consultants came across the following. There has been a series of overclaiming of donations. Also, some of the revenues are not recorded in the books of the business. Kofi, who is in charge of this assignment, informed the director what they had found, and the director said the issues could probably be ignored, adding with a smile that paper never refused ink. He concluded they have special packages which Bugum Limited has prepared specifically for the team required. Using the information provided, discuss the ethical and professional issues in taking the tax assignment from Bugum Limited.
What are the ethical issues in the statement given? The company Bugum Limited, they were overclaiming what? Donations. Their donations was not following the worthwhile causes principle. They are overclaiming donations. And then they were also not recording some parts of their revenues in their books. And when the person in charge of this investigation noticed these practices of Bungu Limited, informed the director. The director is telling them that what paper never refused what an ink. That they even have a special package for them, for the team. So you have to use the information to discuss ethical and professional issues in taking the tax assignment from Bungu Limited. So what are the ethical principles?
There's a likely of self-interest threats.
Why was that what you were reading?
Is that?
Was that what you wrote in your mock paper?
Yeah, I wrote something like that.
Self-interest threat. Okay, you read what
Yes.
I'm written first, then we look at your own.
Okay. Ethical and professional issues. The management intentionally omitted some of the revenue in the company's records, and this unethical behavior of the director will reduce the tax liability and amount of revenue furnished to GRA. Failure to maintain proper records is an offense according to the Section 73 of the Revenue Administration Act 2016, Act 915, and attracts penalty. It can be noted that management's behavior in this case gives the impression of unprofessionalism.
Okay, wait. Let me ask something before we move on. Failure to maintain proper records. What's the penalty? What is the tax principle on it? Failure to maintain proper records. You know, you're supposed to keep records, and the tax principle allow you, the commissioner general have the power. You are supposed to keep your records for at least 6 years before you can dispose of your books. 6 years, you are supposed to have your records there. In this case, the company, they are not recording part of their revenue in their books. So it means that they are not keeping proper books of account. And failure to keep proper books of account is an offense. It's an offense. And the Commissioner General have the power to come and look at your books, to do the tax audit and charge you penalty. So I want to find out, how is that penalty determined? How is the penalty determined for failure to maintain proper books of account? Okay, so in that case, the Commissioner General have the power to look at your books, the area or the period in which you have not kept proper books of accounts. The Commissioner General, based on the available information to the Commissioner General, and based on the information and the current update that the Commissioner General have about your company, Commissioner General have the power to look at the period and compute any tax liabilities for you. And that tax liability, the Commissioner, the penalty will be 75% of the amount that the Commissioner General will determine. So that one, it is at the discretion of the Commissioner General. So when you fail to keep proper books of account, Commissioner General have the power to come look at the period in which you have not kept proper books of account, and based on the available information to the Commissioner General, give you any tax liability you are supposed to pay. And that amount, the penalty is 75% of the amount determined, that will be determined by the Commissioner General. Okay, so let's move on.
There is a series of overclaiming of donation, which equally reduces the chargeable income and amount of tax paid to GRA. According to Section 100 of Act 896, donation made to only worthwhile causes are deductible. This creates ethical issues if management intentionally overclaimed the donation to evade tax. Should I continue?
Yes.
These actions raise questions about the integrity of the management of Bogun Company. Therefore, management is likely to influence the decision of the tax consultant, looking at the fact that they have designed tempting packages for the tax consultancy team. This will create a self-interest threat for the team, and should the consultancy team accept the offer, the integrity and objectivity is likely to be compromised.
Okay, thank you. I'm sure it's the same thing you want to say, isn't it?
In fact, those three things that I mentioned under the thing, right, is what I wrote as my major point.
All right. So guys, we'll end the class here. We will meet next time, then we will continue from question 6.
So that'll be Saturday.
That'll be Saturday, yes. That'll be Saturday.
So what time?
1 o'clock.
Saturday, is it not 2 o'clock?
No, it's 1 o'clock. Or is it Sunday that is 2 o'clock? Or
it's 2 to 6.
Saturday?
Yes.
Hey.
It's 2 to 6.
Okay.
Yeah. I believe the revision is very truthful. It's very helpful. Oh.
Saturday is 1 p.m. to 5 p.m.
Really?
Yeah. Unless maybe if you want to change it now.
No, it's 1
because
p.m.
Because 6:30 we have corporate reporting.
On Saturday.
Yes, so we can't close 6 o'clock, then 6:30 we go to another class.
Yeah, it's 1 to 5. It's 1 to 5. Okay, all right. Well noted. And Sunday to the same time for advanced audit. Yes, Sunday to the same time for advanced audit. All right. All right, so we will end the class here. Then we will meet on Saturday. We'll meet on Saturday. Thank you for coming.
Sir.
Yes, I can hear you, Senior.
Sir, please, a quick one.
All right.
You see, with petroleum and mining.
Okay.
where the capital allowance is computed differently, where the all the assets are put, assets purchased within a year are put under one pool.
Yes.
So that one doesn't matter whether the asset is a plant or machineries or motor vehicle. You just put all under one pool.
Yes.
And
Capital allowance is 20%.
20%. Okay.
Yes. So under petroleum and mining operation, capital allowance, it doesn't for the pooling system, no. All
Okay.
assets are being put together. You add all of them together, and capital allowance is straight line basis, 20%.
Okay, sir.
All right. We will do that. That's what we'll be doing next on Saturday. We will
Okay.
go through that one together.
The same link.
Not yet, but I may reshare another link. I will share another link.
Okay, sir.
Yes, I'll share another link.
Thank you.
All right, thank you.